Well, good morning, everybody. Welcome to those of you at home tuning in to the London Forex eShow. We're coming to you live from the conference room 1 in the Hilton Olympia on a rainy London day. We're just about to shortly get started with Rishi Patel, and he's just going to be speaking to you next up. What are you doing?
Hi, welcome everyone. I was just asked to do a little bit of a forward to our friends and partners from Master Markets. My name is Yanis Kandatis. I'm the editor and publisher of the magazine you pretty much hold in your hands. So Traders Magazine, together with Master Markets, we've been doing quite a few shows and organizing pretty much successful trading.
Get him off quick, because nobody can hear him at home. So just get him off.
What we've been doing is giving information on the magazine you've been holding. Much better than that? All right. So the magazine you hold is obviously foreign exchange related for this month. Is monthly, and just a few words on it. We've been in the UK for many years. We're doing it with in other languages as well, Spanish, Italian, Greek, as myself, and obviously in Germany, where the magazine comes from. And it's now going on a printed basis as well, so you receive that for free as a complimentary copy today because of the event. And there are information inside if you want to receive this on a more regular basis with an early bird discount and so on and so forth. The magazine also has launched a webinar guide, so it's a sister website which you can find information in there, where webinars like this today you can find throughout the year. It will be a one-stop shop for you to see what's going on in the finance industry. If you want to attend and watch a webinar and then maybe watch it at your own convenience to your home as a podcast. Traders Magazine is it's been a publication for the past 5 years, and you've got articles and interviews in there on all strategies and products. So feel free to let us know if you want something more to see in there, strategies on different stock exchanges or different products. But this is pretty much the quality you'll be holding in your hands from now on. So I'm not going to hold you more. I think I'll pass it on to Rishi, and you're going to follow a very interesting webinar. Myself with other colleagues, we're hosting your lunchtime summit at 12:15. So I'll be pleased to see you all in a little bit later. Thank you very much.
Well, good morning, everyone. Oh dear, mic 1, 2. Is it working, Simon? Yeah. Good morning, everyone. Good morning. Good. My name is Rishi Patel. Company's called Master the Markets, and I've been in this space for several years now. And anytime I come to one of these talks, normally what I find is people will stand behind the thing and deliver a very monotonous talk, and I don't want to do that. So my presentation style is slightly different. So it's very interactive. We're giving out some prizes, and there's lots of games and all the way throughout this presentation. I've only got 30 minutes today, so I'm going to be pretty quick. If you have any questions, I'd love to connect with you all and have a conversation and work out what your goals are and where you'd like to get to. So my name is Rishi Patel, and Simon's given me access to be able to click onto my slides now. Very soon, here we go. Okay, there we go. So my background is really in computer science. I did a degree in computer science, and I found out very quickly that was not my forte and not my thing. So I dropped out of that, and I completed up part of it. I didn't get the BSc or anything like that. And I quickly went on to start a video production business because that was really something I enjoyed at that time. And it was really good fun and really loved making videos. So my girlfriend at the time said to me, hey, you know what, why don't you do this? I'll help you with the business side of it. And great. And I did that, and I started that business, and I did that for a few years. I cleared out my life savings. I bought all of this video production gear, and I went over and I started doing this work, and I got some great contracts. I did some work for the NHS. I did some work for Watford Council, John Lewis, stuff like that. And then in 2008, who knows what happened in 2008? The crash, right? The crash affected my business severely. I was very new in this space, and all of these corporate clients that were spending money with me stopped. And at that time, I needed to do something which would bring me in an income. And that's the time I met Tiru Nagapan, who you'll see is probably in the magazine and on the talk and on the title for this talk. And I met him, we had some very similar goals, and so we started to trade. The story of how we got into it is actually pretty incredible. We took this 2-day workshop on, which we paid £2,000 plus VAT for. Now looking back on that, we were offering something much better, much more value, for a lot less. But regardless, beside the point, best investment I ever made because it's brought me up to the point that I am now. Tiru has asked me to step in on this talk because you'll see his name is printed in the talk, and what I'm going to be doing is talking about something very similar to what he was going to be talking about. The only reason that I stepped in is because we've developed a brand new strategy, a brand new trading system, which is called price expansion. Profit expansion, and that profit expansion strategy, that trading system, is something we're giving away. So he wanted me to share my results about what I'd achieved with that so far, and I wanted to do that and take the slot. So that's the reason for that just there. I speak regularly at various conferences in and around the world. This is a conference that Easy Forex ran in China, so I was down there. We delivered short talk for them over there. Everything that we do is very much trading first and then training, okay? So we do our trading business, it's called Master the Markets, but we're traders first. So we trade the market live every single evening, and people watch us do that, and a lot of them will copy the trades that we're taking. I don't recommend doing that because I recommend you learn the analysis and understand what you're doing, and then copy. But if you choose to copy, then obviously, people do that. It's not the thing that I would recommend or advocate. We have a transparent track record. Every single trade that we've ever taken from April 2012 is logged on an Excel spreadsheet with the exact entry, exit, all the criteria. Now you can't see this because it's quite small, but it's basically all of our results from April 2012 up until now. And over that period of time, we have a 48.16%, I think it is, return on our capital. Over that period of time. So everything we do is very transparent. Some of the recent trades that we've taken in the last couple of days, everything we're doing here that I'm showing is on daily bars, by the way. The reason for that is because I would much rather just have 15 minutes in the evening, we analyze the market, put the orders on, and then do other things during the day. So very much geared at people who are maybe in a full-time business, or maybe they are working on a full-time basis. We want to create another stream of income, or just create wealth long-term. Would be the type of people that we would generally tend to work with. Dynamic breakout, this trading opportunity, this was on the Australian dollar against the US dollar, and it grossed £1,000 profit for us. The risk was just 1%. Everything we do here is very risk managed, and that's our first and utmost thing. We want to manage the risk and cap any downside. So it was 1% risk, but it grossed a great profit for us there, and we were in that for just 2 days. Just took a minimum amount of management. Next trade that we took was here on the euro against the Japanese yen. We actually went short on this just here. That moved against us, and we were out for a loss of £500 just there, and that took 5 days, 15 minutes. And then we saw another signal on the euro against the Japanese yen. Again, we got in on this green line. We got out just here short, and we made back the loss that we had taken just there. So that was those two trades. All of our trades logged transparently, as I say, trade by trade, every single individual trade, entry, stop, exit, everything that we do. It's very transparent, 48.59% at 1% risk up until last week with the actual results that we've achieved over that time. So that's our equity curve, which we plot. The one thing that you should note about the equity curve is not the percentage profit or anything like that. But remember, because we're traders first, we're very aware of what drawdown is. Drawdown, obviously, the distance between your peak to the trough in this equity curve just here, the maximum amount you can lose at any given time. So we know, we're very clear that our max drawdown on the live trading room is 4.56%. Okay, so we won't lose more than 4.56% of our trading capital at any given time. If you're a trader and you do this professionally, you should know your statistics inside out. So if you speak to anyone else that's trading on a full-time basis, ask them what their maximum drawdown is. People should know this stuff. I think the statistics are very important. The statistics actually lead to you having a more higher, huger belief in what you're doing. If you have that strong belief in what you're doing, that conviction in your trading, when you're taking trades in real time, you're actually able to trade with a better level of conviction as opposed to second guessing, being like, shall I take this trade, shall I not? You're absolutely clear that you should or shouldn't take a trade if you know your numbers and your statistics, your drawdowns, and all the other numbers around that. So very, very important. We also hosted the Elite Traders Conference. This is a gentleman is Mark Brown. He's pretty much the pioneer of automated trading in this space. You can look him up on LinkedIn. He has 40 years worth of trading experience. Very, very honored to have been mentored by Mark. He's very well known in the quant space. He's a quant trader, and he's taught us how to quantify all of our parameters. So that's the idea just there. We also presented a photo from the Elite Traders Conference with Mark delivering some of our advanced clients just there as well. Traders Open Day we also hosted back in October 25th, and that's myself delivering a presentation there as well. Some of the traders, some of you will recognize, maybe Steve Ward, David Paul from the mix, and then there's Tyrrell and myself. We also spoke on the day as well. So what I'm going to do in this presentation, my core objectives are, I'm going to show you how you can build a successful trading system, what the key concepts are, and what the fundamental building blocks for that is. You understand how you can test/analyze a strategy's performance, and you're also going to find out more about the elite strategies that we personally trade and the systems that we've built, and price expansion, in this case profit expansion. So that's the one just there. If you want a PDF of this presentation and some advanced trading videos, if you give your details to one of my team, these guys are walking around with some forms. You can just fill them in. They just fill that out and just put an asterisk next to your name so we know to send you a copy of this stuff just here, yeah? We also have this really cool 5-day video series. We've just finished making it. This is geared towards beginner/intermediate traders who want to understand how to become a little bit more consistent and the basic building blocks of FX trading. Now this is really cool because what we did with this is we made it into a movie. So we actually took 9 months, we made this entire movie around how people can trade and make money from the FX markets. So we made that into a movie and it looked really good, so we launched it in the Empire Cinema in November last year. So if you would like a copy of that, again, just leave your details with one of my colleagues. So let's talk about building a trading system. By show of hands, who is trading already and has already got some experience with trading markets? Okay, just a few of you. Okay, and who has never traded before? Okay, just a couple of people. Okay, so most traders actually use an inconsistent set of parameters. Okay, and what they do is they inconsistently execute those inconsistent parameters. What that leads to is an invalid set of statistics. The numbers you get at the bottom line don't mean anything after that. Okay, so that's the biggest problem that most traders have. So what we do is we actually teach traders how they can actually build a trading system, and that trading system gives you everything that you need, all the various components inside there to be able to make consistent money trading the markets, as opposed to being involved in the market and being ups and downs and sideways and winners and losers and being flat. Right? Most traders that I speak to that have been trading for a little while are not making consistent money. They're ending up flat. They're making profits, losses, profits, losses. Okay? But what we need to do is build a system that gives us consistent profitability. And to do that, you need these 3 components. You need a strategy component, which has a crib sheet inside of it, which has rules for entry, stop, target, has money management inside it. You need a psychology component built into your system as well, and then an optimization component. You need to know how to learn, how to read your statistics, what they mean, so you can draw the information out of that, and you can use that to optimize your system to get better profits the next time around. So this leads to a consistent set of results and consistent profitability inevitably. Okay. If you want to test and analyze your strategy's performance, what you need is you need a crib sheet, which is the rule set. You need back testing, optimization. You need forward test on a simulated account, then forward test on a live trading account. Up to $100,000 is fine. And then afterwards, when you've done that and you forward tested, then you trade on real money, and then you can deploy a strategy. You need to go through this cycle in order to be able to make consistent money long term and have belief and conviction to carry on trading the system even through drawdowns. So what I want to do is just to make sure that everyone's paying attention, no one is falling asleep. We'll have really great little prize and a little interactive exercise as well. So this is a discount voucher from the Master of the Markets product range. We'll give you 50% off. And what we're going to do is just ask a very quick question. So here we go. If you were to remove the open and the close from 2 OHLC bars, you've got just 2 bars there. How many variations would you get, excluding equal highs and lows? Does anyone have a go at this? You've got 2 bars. We've removed the opens and the closes. And you can't use equal highs and equal lows. How many combinations of bar can you get from this? Does anyone want to have a go? If no one wants to have a go, I'm going to tell you the answer. Have a bash. 4. Who said 4? Okay, very good. What would be 4? Yep, good. Very good. Second? Yep. Very good. Superb. All right, what's your name, sir? Pete. Give Pete a hand. Superb. The first time a quant trader asked me that, I was lost and I couldn't work out the second and third ones, so the third and fourth one. So very well done. So here are the different. Well, we'll go back to our presentation. Here are our combinations. So we've got higher highs and higher lows. We've got lower lows and lower highs. Then you've got an inside bar and an outside bar. So this, well. Sorry, Rishi. That's okay. There we go. So this is momentum strength, and this represents market compression. Okay. So this is these key models. Now, really interesting statistic, cool fact. This sets up 40% of the time in the market. 40% this sets up. This one sets up 40% of the time. This sets up 10% of the time, and this sets up 10% of the time. Now, the research that I've been doing is around this pattern just here, which is inside days. Okay, so I want to share some of the results from that research with you. Now, if you take and if you include the actual open, high, low, and close into this combination of bar patterns, you actually get 256 variations. So there's lots of different stories that price can tell us, and the one that I'm doing is what we call here profit expansion. This is my trading system, and it works around inside bars. Been doing a lot of research around this, and we have some fantastic results. So an inside bar, just so that everyone's clear, even for those of you who may not have done much trading in the past, is just a bar which is engulfed by the previous bar. That's all it is. Does that make sense to everyone? Everyone's following. So a bar that's engulfed by the previous bar. What that means is that the market is compressing, and there is an element of indecision. Okay. Now, indecision, generally speaking, is followed by an aggressive breakout. This research has been compiled by our MTM research team, and what I'm going to do is I'm going to show you the results that we got from testing this. So we looked at 5 different exits. We asked ourselves, if we want to get out on the high of the previous bar, what would be the results? If we want to get out on the close above or below previous bar, 3 buyer bars, previous swing high or low, and 10 periods, what the results would be. So what does that look like graphically, just so I can show you? The first exit, if we entered this inside bar, the first exit would be on the high of the previous bar just there. The second exit would be on the close above the previous bar just there. The third exit would be, the fourth exit actually here is on the previous swing high, and the third exit is on the close of the third buyer bar just there. So, and the fifth exit, the final one we tested, was how it would happen in 10 periods. Yep. So we asked ourselves all of these questions. We said to ourselves, if we were to test and we would trade inside bars, and we wanted to get involved and make consistent money, what would happen across these 5 exits? Which one would give the best results? So, everything that I'm talking about and the entire rule set and the strategy and everything is actually on this CD. And you can, if you put your details down with one of my colleagues, then you can actually get one of these CDs as well. We're happy to. But I've only burnt 18. The other thing is I don't want to give out too many of these because strategies work based on an edge. Okay, so there are 18 of these available. Right. So anyway, I'll show you some of the stats and findings from the research. Would that be good to see what the research looks like? Would that be good to see?
Yeah.
Fantastic. It's just Simon that wants to see the research. Maybe we'll just sit down and grab a coffee, Simon, and we can go home. Okay, good. So here we go. So 5 exits were measured over 3 years. We looked at 3 currencies, pound dollar, euro yen, and euro dollar. Okay, were the 3 currencies we looked at from 2012 to 14. We've compiled all of the results based on 4 degrees of freedom. So there are 4 key criteria we're looking for to enter the market. The trends identified by price action waves. We looked at fib extensions, retracements, also taken into account. Stops are based on technicals and kept consistent. Entries and stops were kept consistent. Only the exits were varied for this research. Okay. If you want to know more about what this means, then just talk to me after or talk to one of my colleagues. We'll sit down in a one-to-one. Let's grab a coffee and I'll walk you through it. I've only got 30 minutes to present today, and you can see I'm really passionate about this. I love this stuff. I love to talk to you all more and connect. So make sure you put your details down so that we can connect. This is what my journal looks like. This is the price expansion journal. And again, okay, one more interactive exercise before we look at the results. So here's the interactive exercise. It's for a 50% discount voucher of an MTM product. Multiple types of exits were tested, I said. There were 5 exits that were tested. The question is, for the period that we tested, 2012, 2014, which exit gave us the most profit? Which one of these 5 exits do we think gave us the most profit? Who thinks exit 1? No one thinks exit 1 gave us the most profit. Okay, who thinks exit 2? Okay, who's not sure where they are?
I think exit 1 gave you the most profit.
You thought exit 1. Okay, great. 1 as well. Anyone think 2? No one thinks 2. Anyone think 3? 3? Exit 3? Which was 3 buy bars. Exit 4? Anyone? Which is the previous swing higher, swing low. A couple of people. All right, brilliant. Okay. And then exit 5 is 10 periods. Anyone think exit 5 holding for 10 bars after? No one. Okay, great. So let's have a quick look. Here are the results. So we've got the number of trades, how reliable it is, i.e. how many of these trades win and how many lose, percentage-wise. Net profit from the strategy for 3 years, 3 currencies. The average profit to loss ratio, the R multiple, and the profit would expect over 100 trades based on that. So exit 1, there were 109 opportunities over the 3 currencies over 3 years on daily. Okay, it gave us a reliability of 55.96%. That means 5.6 out of 10 trades made money, in a nutshell. 29.2% was a net profit. Exit 2 gave us 53.62 profit. Exit 3 gave us 44.13 profit. Exit 4 gave us 36.37, and exit 5 gave 31.96. So exit 2 actually was the most profitable. No one said exit 2, so no one won. Okay. Don't worry, no problem. And I didn't expect anyone to guess. Actually, when I looked at the results, I was pretty surprised that that particular exit would give that kind of result as well. So that's pretty interesting. So the reason we do this research, again, is because when you're trading the market in real time, in real market conditions, and you're looking at a trade, you're involved in an opportunity, you may have 6 or 7 or 800 or 2,000 pounds running on the table, but where do you take your money off? Where do you close it? So if we can work out all of this stuff in advance, then we have absolutely no doubt in our mind that we need to get out of the market there. Does that make sense? Yep, so we do this exit, so we do this research, so we can work out how we can make consistent money with conviction in any market, any time frame. Okay, any questions? There are no questions. In a presentation, if there are no questions, it generally is one of 2 things. First, everyone is really confused and they don't know where they are. Or 2, it's such a good presentation that leaves no room for questions.
You're number 2, obviously.
Okay, so this is as good as the jokes get, so I apologize in advance. Okay, so we're going to have a good time here. All right, so when we look at these results on an equity curve, if we plot the equity curve by month, by date, then you can see that actually exit 2 does gross us the best profit over a period of time, and exit 3 is pretty close as well. Which is the second line down too. So we compile everything so that we know when we're trading a real market exactly where to get out, exactly where the money is made in real time. So if you want to get access to this whole presentation, all the exits, or the script sheet, the strategy, everything, make sure you put your details down with one of my colleagues and we'll send that out to you afterwards. We'll sit down, we'll grab a coffee. So this price expansion, I've been trading for quite a long time, which is why I know exactly how to attack the research. So we're looking at a price expansion here on the dollar against the Japanese yen. Again, we held this for 3 days. It grossed $1,965. I was in Singapore when I took this trade. I just took it on remote control. The office was set up and off we went. So the great thing about trading, I'm sure most of you know this, location independent. You can do this from anywhere in the world because we're just trading daily as well. We're trading 15 minutes. I only need to look at the market for 15 minutes. We still gross some great numbers. So that's the price expansion just there. Don't forget everything we're doing is really risk managed. So that's the key. Good thing for you guys is you can leverage off of real trading results. Okay, so real trading results, we've put together the research. We teach you how you can do the research so that you can go and test and build any strategy and trade it with a level of conviction so you can make consistent money. Haven't come across too many people out there in this space that's doing that. So that's the key just there. Make sure we book a time. I'll show you how to do this stuff, and it'll be great. We'll grab a coffee and we can walk through it. So the gift of now, interactive exercise number 3. So what we're going to do now is we're going to give away a free 2-day ticket to our trading workshop. A free 2-day ticket to our trading workshop, valued at $19.97 plus VAT, and we sell this on our website for £497 plus VAT. So give away a free ticket to the workshop. The questions were, how many, if the first person that can answer all of this for me, how many exits are there in the price expansion system, which produced the highest result, and how much profit did it make over 100 trades? I wonder if anyone wrote it down. 5-2 and? This gentleman is so close to getting a free ticket. What is the answer? Does everyone want to put their hand up and give me a yes? 57. This is this gentleman here. What's your name, sir? Max. Can someone make sure that Max gets a free ticket for our 2-day workshop? Give him a hand. Fantastic job. Good. That is superb. So we're just checking who's paying attention. Brilliant. Good, good, good. So in summary, if you have a quantifiable set of parameters, i.e. you're not guessing where to draw a trend line, or you're not guessing where a swing high or a swing low is, if you have an exact parameter set, you can make consistent money. Most traders do not have this. They're guessing where a trend line is. They're guessing where support resistance is. If you guess, your results are poor, and you'll never make consistent money. This is the problem that most people have. Our mission as traders in this space is to educate people about having a consistent set of parameters so they can make consistent money. This is what we do in the live trading room. We've been doing it live for 33 months. We take every trade in real time. We publish every trade in real time. We can't hide because there are 150 people watching what we're doing. And so if we're not making money, they can see that. So that's the thing. So that's what you've got to do. If you can build a consistent parameter base, you will have a profitable system which you can trade in real market conditions. Okay? So just to summarize very quickly in this space of time that I had, which was really, really short, I have just gone over the basics of how you create a successful trading system, the components that you need. Test, analyze your strategy's performance, and build a trading system for consistent profits. So we showed you how we put some core basics together for a trading system. Everything is on that CD. If you've put your details down, we can send you out a copy. If you were in the first 18 people, do that. And we've shown you how we've built a strategy, we researched it, and it's given us a great set of returns as well. Okay, so that's what I've covered in the presentation. What you can do is, if you want to interact with us on an ongoing basis, we have a fantastic live trading room. We have a live trading room, and you can take your first steps with that, with 3 trading systems. We'll give you the access to come onto that. We'll also give you some bonuses around that too. We do our live trading room every evening. It's a screenshot of it. It makes us consistent and ongoing profitability. We give people constant ongoing support through the forum of that live trading environment. You log in. It's a webinar-based platform. You don't need any software. You can be anywhere in the world. You log in, watch what we're doing, learn the analysis. It's not about watching. We're going to take trades here. More than likely, we're going to make some money. But it's not about that, because that's not sustainable for you. As individuals, you need to learn how you can be independently profitable. Okay? And that's my core goal, to make you independently profitable, so you don't need to rely on anyone. Does that make sense to everyone? Hello? Does that make sense to everyone? Right, great. So you can make consistent profits. That's the idea just there. So what we do is we give a bonus around with that as well. We give you 3 hours of one-to-one coaching, so you can come in, we can show you some of this research in detail, we'll sit down with you, we'll go over any questions that you have. We'll also give you a research journal. So we've built an amazing research journal which has all the formulas in it, which has all the calculations you need to log if you want to make consistent money, and also a copy of the Traders Magazine as well from our affiliate partners at the Traders Magazine. Just to wrap up, there is a PDF of this presentation, advanced trading videos, a 5-day video course which we launched in the Empire Cinema, and the expansion trading system on CD. If you haven't already given your details to one of my colleagues, then you probably won't be able to get that. If you want to have all of this, just drop your name and your details on that little pad over there, and let's meet for a coffee as well, and I'd love to talk to you more about this. They've only given me 30 minutes. I wish I had 3 days to talk to you all, because we really go into some amazing depth. But that's it from me. My name is Rishi Patel, Master of the Markets. I'm happy to take any questions at this stage.
Can I ask you a question? You know you've got 5 exits, you showed 5 exits. So I think from memory your 5th exit was you exit after 10 periods.
Mm-hmm.
What happens if the price continues in the direction you want it to go? Do you stay in or do you...
That's a great question. So what I'm going to do is, because the webinar wouldn't have been able to hear your question, I'm just going to repeat it and I'll answer it. So the question is, the 5th exit is 10 periods. What happens if the price continues to run after that? Do we exit or do we stay in? So it's a great question. Thank you very much for that. So the answer to the question is, the reason that we test is because we want to find out what happens optimally over 100 periods, over 100 trades. So we want to look at 100 trades. We want to understand what happens over 100 trades so we have the optimum exit. So even if the price continues to run, what you're talking there about is 1 trade or 2 trades or how many trades. My question to you back would be, how many trades run further beyond 10 periods, and is it more efficient to hold that? And the only way you can answer that is by looking historically and doing exactly what we did. So perhaps you would hold a trade for 20 periods and ask that question. Now, from my experience, for this particular profit expansion strategy, the 2nd exit, it does deliver the best results, which is a short, sharp expansion. So generally speaking, it's better to take your profit off the table a little bit sooner if you want to have higher amount of profits, better reliability. One other thing as well, I will mention, I'm happy to take one more question as well. I hope they'll give me an opportunity to give one more question. So if you have a question, let me know. One other thing I will say is, for everyone listening on the webinar, if you would like to qualify for the price expansion CD, for all of the PDF of the presentation, everything that I've said, if you send an email to our team, these guys will type the email address in that you need to send to clientservice@masterthemarkets.net. If you send an email, these guys will type it into the chat box, clientservice@masterthemarkets.net. Then you we're happy to take appointments and send you out a CD as well. Just send us your details. You need to send us, if you're sending an email to clientservice@masterthemarkets.net, what you're going to need to do is send your name, your email, and a mobile contact number so we can arrange a time to talk. Okay? Name, email, mobile contact number. You must include those 3 things, otherwise we can't make a booking and send you out stuff. So are there any other questions? Let's take one more question before I wrap up, or before they kick me off. Everyone's really shy. No other questions around that? Everyone's an expert on trading systems.
Do you, when you enter a trade, do you look at what the prevailing trade is over a longer time period?
The answer is yes, and let's go into the exact detail on a one-on-one. Happy to do that. It's just that the amount of time that I have, I can't go into all that detail. I really want to. And if it were up to me, security would have to haul me off the stage. But we're not going to do that. We're going to wrap up just here, and Simon sent me to...
Shall I take a question from...
Yes, I'd love to. What's the question?
Gary Michelle asking, do the profit expansion trades only work in bull markets?
Superb question. Do the profit expansion trades only work in a bull market? Really good question. The answer is no. We're able to trade the market in 2 directions. I have tested, and all of these results that you've seen for the profit expansion system, that actually works in 2 types of market. We've taken the trades long and short. So depending on what the trend is, we take the trade in the direction of the trend. So if it's a downtrend, we can take it in a bear market as well. If it's an uptrend, we can take it in a bull market. So no problem there. It works on every market. I just gave a quick example of a long trade because I'm time restricted over here. I would like to take 3 questions. So if there's one more, then I'll wrap up. Anything on the webinar, Simon? No other questions?
No.
Abel? Abel.
Say on the price expansion strategy, do you price track? In other words, do you wait for the price either way after that?
Great question. So Abel is asking the question, and Abel is obviously one of my advanced clients. You can see that by the caliber of question he's asking. Do we price trap? Price trapping, just so you will understand, in a nutshell, is capturing the price in either direction, be it long or short, once it breaches a certain level so we can catch momentum. So the answer is, for this particular trading system, is no, we don't. We only trade in the direction of the prevailing trend. Superb. Thank you very much for the question. That's 3 questions. Is there anything else? Wrapping it up. Rishi Patel, Master of the Markets. Look forward to connecting with you all. Come and say hey, and if you've got any questions one-on-one, then I'd love to answer those. Thank you very much. Back to Simon.
Well, thank you very much. And to those of you at home on the webinar, my apologies for not being able to respond to the questions during the presentation. There is a conflict between the GoToWebinar software panel and the slides that we're actually using live here in the conference room itself. So I'll try and address these questions during the break times as much as we can go. But so far as I can see, everybody's able to hear and see okay, which is the two key issues. So we're going to take a short break now while we transfer to the next speakers here at Y from the Traders Cosmos. We'll be getting underway at 11:30, so just over 10 minutes. We'll take a pause for a quick break. Thank you. Welcome everybody. We're just about 11:30. I wonder if I could just ask those on the webinar if you're seeing our slide, The Trigger Cosmos, which is the next seminar coming up with Zahir Anwari. Okay. We'll make some adjustments to the sound. We're just getting ready to go. Sound away. This song for us. Maybe 2 nights. Okay. Good idea.
Hello everyone. Hello everyone. Can you hear me? Yeah.
Okay, good morning everyone. How you doing?
Good.
Okay, simplicity is the ultimate sophistication. Leonardo da Vinci. So in this presentation, what I'd like to present to you is a style which is probably very little understood, but it's probably the most lucrative way for private traders. Now, we know the success rate in trading, but I'm here to tell you that with a few changes and with a little bit of understanding, anyone can do this. If I can do this, anyone can do this. Now, there's nothing special about me. I come from a normal background, but what I wanted was more in life. I've got a background in photography and teaching. But what I understood when I was photographing watches that cost £30,000 and I couldn't afford them, something was wrong. And so I took control of the situation. Now,
You might want to, sorry to interrupt, you might want to turn the sound off on your PC. I think we're getting the
yeah, okay.
Yeah, did everybody hear that?
Yeah.
I think it's just the sound. Sorry, we're trying to do two things here at once. It's been a bit of a learning curve for us all. Too much technology, I think it is, isn't it? It's the problem.
Okay, good to go?
That's much
Yeah,
better. Thanks.
fantastic. Okay, I'd like to start this presentation by playing a video. It's 2 minutes long. There is some sound to the video, but I'm not sure if it's going to come through. Okay, but it's not so much about the sound, it's about what you can see. So the video has got the daily chart, and it's got a black line going through it, which is the daily 200 moving average.
I'll give that 2 minutes. Okay, so sorry for the lack of sound.
So is this you live trading, is it? This is
Now, it's a video that I've created.
Right.
Time-lapse video.
okay. What are we looking at exactly?
We're looking at a daily chart,
Yeah.
and the black line going through the daily chart is the daily 200 moving average. So what price is showing you how it reacts to the daily 200 moving average, okay, and how trend traders use this.
Use the sorry, people at home can't hear you unless you're using the mic. Yeah.
Thank you. Okay, so what you can see is a chart, the daily chart, and the black line going through it is the daily 200 moving average. What I'd like you to focus on is how price reacts to the daily 200 moving average.
And this is speeded up, obviously.
Yeah, it's a time-lapse video. So 616 days. $195 days. 183 days. And 174 days. So what you can see here is how price reacts to the daily 200 moving average. Now the daily 200 moving average is used to give a bias in price action. So when price is above, it's a bull market, and that's where you want to limit your buying opportunities. When price is below, it's got a bearish bias, and that's when you want to limit your trades to shorting opportunities. Now certain sections, not all of this, but certain sections of these bull and bear market is where you will find long-term traders. What they're looking for is a certain pattern called trends. Now, the best way for me to explain what a trend is to look at something that we all know, which is fashion. Okay, so fashion trends. The 60s.
You need to really keep the mic, sorry.
The 60s. My generation grew up on the air bubble. Yeah, David Beckham, always setting a trend. Ladies now getting in on it. And of course, today's good old hipsters with their beards and their lovely fashion sense. So why am I showing you this? Because trends, the way we know it, are seasonal. Trends are seasonal. So that's a minimum of 3 months. However, if we look at these pictures, we can see that trends can actually last a lot longer, sometimes years. So we should be looking at price action in exactly the same way. A minimum of 3 months. Traders will be looking to find trades for weeks to months. Investors, possibly years, which is very much in line with fashion trends. Now, I'm often told that these trends are once-in-a-lifetime opportunities. Have you heard this? The drop of the euro-dollar currently from 1.4 to 1.1, that's 3,000 pips approximately. That's a once-in-a-lifetime opportunity. Okay, we can see from these next set of slides that these aren't actually once-in-a-lifetime opportunities. This comes from a fundamental lack of understanding price action. And this comes about from the creation of the internet. Private traders have been directed down a wrong route because of this in and out style of trading. What we need to do as private traders is to go back to the old school before the internet and look for these long-term trends. So these are trends that I've caught. The US dollar, the dollar against the Singapore dollar. You can see the trends from 2005 to 2007 and then 2009, 2011. We've got the Euro Aussie dollar, 2009 to 2010. We've got the Aussie dollar, New Zealand dollar, 2012, 2013. We've got the Japanese yen. You can see two trends. This year, the Japanese yen moved a good few pips as well. If we look at the euro dollar, currently the euro dollar, you can see 1.4 to 1.1. But look at the past. We can see 2001 to 2004, 2008, 2006 to 2008. Now, these trends also appear across all markets. A mistake that a lot of traders make is focusing on just a single market. This is a stock that I traded in 2014, so last year, the Marriott. You can see it's almost doubled in value, 40 to over 80. And this is a current stock that I'm trading, which is Kruger Co., which is a grocery store in America. Crude oil is another example, which has dropped from 100 to around 50. I've been holding that since 90. Okay, so these trends appear again and again and again. Okay, now, how do we establish these trends? That's the question. How do we look at the chart and know when these trends are emerging? Okay, and this is a fundamental point. What you guys need to do is have a very open mind at this point, and I'm going to show you something that probably a lot of people may have an understanding of, but don't really understand the intricacies, and a lot of people are totally unaware of it. Okay, I'm going to switch to my software. The software that I use is eSignal's Advanced Get. So what you can see is a typical chart setup of mine. Top left is the watch list. Top right is the monthly chart. Bottom left is the weekly chart. And bottom right is the daily chart. Instantly, I'm looking at the much bigger picture. Monthly chart gives me areas of support and resistance. Weekly and daily give me the bias. So how you saw the daily 200 moving average on the video, I've got exactly the same thing on the weekly and the daily chart. Okay, I'm going to start with the Aussie dollar, and at this point you guys can look at your notes because the screenshots are of the Aussie dollar. Okay, so what you can see are the red and the green lines going across the screen. These are my major areas of support and resistance. Something that a lot of private traders struggle with is knowing which are the exact areas of support and resistance we should consider. Now imagine going up a flight of steps. The flight of steps has 20 steps. You just want to go from the first to the 20th without any problems. However, imagine after every 5 steps, there's an unnecessary ceiling. You've got to break through that, and then another one after 5 steps, and then another one after 5 steps. That's the problem that a lot of private traders bring to their trading. What we want is to go straight from the first to the 20th to the next floor. Now imagine the distance between floors are round numbers. So every 1,000 pips. You basically want to go from one round number to the next round number without any issues. Now, people who've been following me on social media, I know there's some people here who've been following me on social media for quite a while, will know about the Aussie dollar because I spoke about it repeatedly. Now, if you look at this area here, we've got an area of consolidation. This area of consolidation is about a year and a half. The longer the consolidation, the bigger the breakout. So I waited a year and a half. Now, if I'm just trading the Aussie dollar, I'm going to be frustrated. So while I'm waiting for this to break out, I'm trading something else. That's a fundamental point. That's why you need a big portfolio. Forex, stocks, commodities, you need everything. Okay, but you can see that once price broke out, which was just below 0.9, and this pivot level here, where did it target? It targeted 0.8. That's the next round number. It's now broken 0.8. Where would we expect price to go to? The answer is 0.7. If it breaks 0.7, then 0.6. If we look in the past, we can see that these round numbers have been hit before. Okay, so when it comes to major areas of support and resistance, look at round numbers. The red and the green lines represent the highs and the lows on the chart, so major pivot levels. The pink lines that you can see here, these are the highs and the lows of previous years, of last year, 2014. So the highest point and the lowest point. Price is now trading below all these levels, so what we should expect is price to target round numbers. Is that clear? Right, good. Right, weekly chart. Okay, the weekly chart. We're trading below the daily 200 moving average. So we've got a bearish bias. Look how long it's been trading below, since April of last year. April 2013, excuse me. April 2013, April 2014. We're now in January 2015. So long bearish bias. I've also got a trend filter on here, so you can see the red and green areas. So this is a proprietary indicator that gives me bullish and bearish biases. I'm not interested in green, red, green, red, green, red. I just want areas of trend. I've got that same trend filter on my daily chart. And I'm below the daily 200 moving average. So once I've established a clean area of space on the monthly chart, I'm then looking for the weekly and the daily to be in alignment by being below the daily 200 moving average, and my trend filters to be in alignment. Okay, is that clear? Yes. Yeah, fantastic. Okay, so I entered the Aussie dollar in November of last year. So when price broke below this pivot support level, when price was below 0.9, this is when I entered the Aussie dollar. I've got 5 positions running. So I'm now scaling in or compounding. You may have heard this term before. Now, the title of my presentation is Master Price Action Eliminates Psychology. There's a big industry now in trading where psychology is everything. I've seen presentations where people have, the speakers got people up and standing in weird positions to get things flowing in their brain so that when they sit in front of the computer, they know exactly what they're doing. If you pass your driving test and you get into a new car, which is different to the car that you were learning to drive in, you've got no instructor. Every 5 minutes, you're stalling the car. Is that down to your psychology or a lack of experience? Right, it's the same thing with trading. There is really no psychology apart from understanding how to follow rules. And this is where psychology comes in, holding your position when the trade is going against you. Now, the Aussie dollar is a perfect example. If you look at the structure, it doesn't actually move in a straight line. Can we see that? Right, so I've had 5 positions running from November. And you can see that I made very good profit for a few weeks, and then it went sideways. There's certain points where the trend's going against me. This is where I've got to hold, because I've still got the bias and trend in my favor. As soon as it breaks out, which is in my favor, I make more profit. Currently, it's going through an area of consolidation. Has this happened in the past? Yes. Is it going to happen now? Yes. Is it going to break out in my favor? Potentially, yes. So this is where psychology comes in, holding when the trend's going against you. Right, let's go for another example. I'm going to bring up the euro dollar. Okay, so we can see that the euro dollar found resistance at 1.4. Okay, and it's fallen straight through 1.3, straight through 1.2. It's now finding resistance, a support approximately at 1.1. Now, if we go to the weekly chart, we can see that we're trading below the weekly 200 moving average, and we've got red trend filter. And if we go to the daily chart, we can see that we're trading below the daily 200 moving average, and I've got red trend filters. I've been holding positions since September of last year when price broke 1.3. I've got 5 positions running. This alone is probably running at about 5,000 pips. Okay, now look at the psychology, look at the structure of the trend. You can see that there's movements where price goes against you. This is where you hold, because the odds are in my favor. You can see that price broke out in December, covered a lot of ground very quickly. What's it doing now? Consolidating, because after every move, there is a breather period. Price doesn't always move in your favor. Okay, let's look at an exotic which I'm currently trading, which is the US dollar Swedish krona. There we go. Okay, US dollar Swedish krona. I entered this when price broke the red resistance level at 7, and you can see now that it's firing up towards 9. Okay, if we go to the weekly chart, we can see that we're trading above the weekly 200 moving average, and we've got green filter. And if we go to the daily, we're trading above the daily 200 moving average, and we've got green trend filter. Does that make sense? Yeah. Now, I often hear people say to me that trends appear on all time frames, and I kind of understand that, they do. But let me explain this to you. If you go into a shop and you spend £2,000 on a tailor-made suit, and you come out the shop and an hour later you get a phone call from Timothy Everest, who designed your suit, and says, sorry mate, but your suit's no longer in fashion. You're going to have to come back and spend another £2,000. How are you going to feel? You're not going to feel too happy about it. It's the same thing with trading. When you keep on getting in and out, in and out, in and out of trades, you're actually missing out on potentially very lucrative periods. You've got to give a trend, bless you, you've got to give trend time. A trend is a function of time. If you eliminate time, there is no trend. Okay. Simon, how long do I have left?
We're okay for another 10 minutes or so.
Yeah, okay, cool. I feel like I'm kind of rushing this. Okay, now, why should trend traders adopt this style? Why? My current positions are running at about 35,000 pips since September, and I've only opened 20 positions. That should tell you why trend traders should be adopting this style of trading. When I was a photographer, I was working 18 hours a day. It's very demanding. And sometimes 5, 6, 7, 8 days on the trot. Photography is not as fun as people think. After a while, a passion just becomes a job. So I needed a style of trading that could be adapted around what I was doing. This takes, once you understand it, it takes about 15 to 20 minutes a day, because we're looking at the monthly, the weekly, and the daily time frame. I spend an hour on Sunday preparing for the week ahead, and that includes all markets, so I know exactly what I'm looking at from Monday to Friday. You're not going to be staring at your mobile phone app all day long. I've done presentations where I've seen people looking at their apps throughout my presentation. And I know exactly what they're doing because I can see the sweat building on their forehead. It's really, really unnecessary. Trading is not what people think it is. Okay? Trading is leveraging your salary. It's not a 9 to 5. How often does Warren Buffett look at his investments? How long? How many times in a year does Warren Buffett look at his investments?
Once in a year?
Once a year, thank you. Once a year. Now I always get the response, yeah, but he's worth 80 billion. Yeah, but he's 80 years old. He started with thousands when he started trading. Okay, he's a very shrewd businessman, and I understand that, but this is not something that is beyond us. It requires application, it requires understanding, it requires investing, and it requires a bit of time. Most people don't want to do that.
Do you ever put any stop losses?
Always use stop losses.
How much?
My stop losses can be as wide as 500-600 pips. What is a stop loss? A stop loss is an area that you're willing to let the price go against you before it goes in your favor. That's a stop loss. I just want to make sure that between my entry and my stop loss, I'm not going to lose more than 200 pips. 200 pips, 2% of my account. Yes, sir.
Yeah, you talk about like consolidation time. You hold
Yes.
your trade.
Yes.
But when you actually decide when you're going to exit for a particular trade,
When do I decide I'm going to
what's
exit?
your criteria for exit?
Okay, it's a good question. I let the price dictate. Is there anything suggesting now that I need to exit this trade? And I've been holding it since September. No, so I don't need to exit. I'm using a trailing stop loss, which is mental, so I don't even go into my broker account every day and change it. I've got a mental stop loss, which is following the price. So this trend now takes me about 2 seconds a day to manage. Because all I do is I look at it and I see what it's doing and I'm done. Yeah, so what's more important, an entry or an exit in any relationship? The exit management is very important, right? So okay, so let me give you an example of this. And I'll go back to the euro dollar. And I'll open up the daily chart for this. Okay, if you actually look at the trend, when did the trend actually start? The trend actually started in May 2014. I didn't enter until September. Since September to now, I've made almost 5,000 pips. There's this unnecessary idea that you need to be getting in at the top and the bottom of a trend. You don't. You need sections of a trend and then compound to see massive, massive profit. The euro dollar on its own has returned me over 35% on my account. So how many trends do I need a year to have a good year? Well, one to beat the bank, but as you can see, we have more than one. Go on, sir.
To be able to, catch a long-term trend, how many positions you open at one time? Because even though obviously these are very, nice charts, I do know that it is rather difficult to be able to get the euro dollar or the Aussie versus the dollar. So how many positions you try to open in one time?
Okay, I'm not quite sure what you mean by it's very difficult. What does that mean?
Not every market actually trends like euro-dollar all the time.
Uh-huh.
I mean, so
Yeah.
it's, you know, every year you do have, let's say, a handful of home runners.
Yes.
Because you're trying to get the home runners, right?
Right.
So to be able to get those home runners,
Right.
how many you bet?
Okay, it's a good question. Okay, this all where as a private trader, where should your emphasis be, on capital protection or making money?
Protection.
Right, exactly. So this all comes down to your appetite for risk. Most people are focusing on the profit. They want to make 600% in 2 months and live on a beach. Yeah, but that's not where it comes from. It comes from understanding risk. I'm happy to maybe expose more than 20% of my account, but across 20 different trades. So I've spread 1% risk across 20 different trades. I've spread my probability. Most people put 20% on a single investment. Yeah, so it all comes down to your appetite of risk and knowing which are the best setups. Where does that come from? Understanding price action. So these home runners, you need to know how to look for them. You also need good software. You can see from my software, very clean, but also highlights trends for me. It's got an inbuilt scanner. So my software actually scans the market within minutes and tells me when things are breaking out. And this is what I should be looking at. So what takes people hours can take me literally 15, 20 minutes. We got a bit more time?
Yeah, we've got about
Yeah.
Software is the other.
5 minutes.
So the other, so the other for entry comes from your software, is it right? Not just, we can't see any alert here.
Yeah, I mean, I can't show you all my goodies, to be honest with you. I mean, there's people here who have paid for the mentoring, and I have to always respect them. But the software does everything. It's got an inbuilt money management system. It's got a tool that will tell you where to enter, where to stop, how to trade your stops. Does everything.
What's your win-loss ratio?
What's my win-loss ratio? If I told you I had a success rate of 30%, what would you say?
Good.
Yeah, because it's not about how many winners you have. It's about how large your winners are. There's this unnecessary thing that you need to... That's how signal services get sold. People waste a lot of money on signal services because there's people out there telling you that this has an 80% success rate. But what about the 20%? It's all about how large your winners are, not how many. Last 2014, I took only 80 trades across all the markets. I took 80 trades. Forex alone brought me 102% return. And that's a realistic target. Most people are thinking like 500, 600%. Look, you know, got to be smart about it. Yeah, go on, man.
Your win-loss ratio, you said you gave a figure of 30%.
Yeah.
Is that an arbitrary percentage, or is that pretty accurate?
It's pretty accurate, I guess.
Well, what is the peak to trough drawdowns that you experience with such a strategy?
Okay, that's a good question. Where would the drawdowns appear when you're trend trading? Where would the drawdowns appear? The drawdowns will appear at the end of trends when they're reversing against you. So the euro dollar is currently 35% in profit, for example. At the end, when the trends reverse, I may give back 5% of that and bank in 30. And then possibly at the beginning of trends where you have fake breakouts. So there are only two periods where I have drawdowns. Drawdowns are part and parcel of trading.
So here, can we take a question from the webinar?
Yes, yes.
Steve Cruz is asking, how big an account would he suggest is required to trade like he does, to take multiple positions, and what is your average risk per trade?
Okay, good. I don't risk more than 2%. And when it comes to learning to trade, you need at least £2,000. Okay, but you guys need to know what kind of account to use. Most people are trading at 50p a pip or £1 a pip with a £2,000 account, and they want to leverage it to $1 million and live the life of Larry. But that's not how it's going to be. You can open up £2,000 account with, say, a broker. I'm not going to really endorse any of them. But you need to be trading at 10p a pip. With 10p a pip, you can have a smart 2% risk. And if you can see between 50 to 100% return on a £2,000 account, you then need to start putting more money into the account. So you treat your trading account like a savings account. Yeah? Yeah.
You know that example you got on the screen? I mean, that's quite a good-looking trend.
Yeah.
So do you, before kind of determining whether you want to enter a trade on a potential trend, do you look at previous price movement and see how erratic that is? Because you could enter a trend and then, you know, retracements on previous price actions are so deep that it just stops you out, you know, quite often.
Okay, what is technical analysis?
It's a study of, it's forecasting future price movements based on historical price movements.
Right, so that is fundamental to technical analysis. But there's a fundamental difference between a technical analyst and a trader. A technical analyst can tell you where support and resistance level are. A trader knows how to get in and hold his positions between those support and resistance levels. So that's all technical analysis is. Sure, you look at the past and it can tell you that you know, certain movements or certain structures have deeper pullbacks than others, but you incorporate that into the way you trade. You know, it's a good question because trends have different structures. This is a pretty fast moving trend, so can I use a pullback on this? No, I can only use breakouts to compound. Whereas if you look at something else like the US dollar, Canadian dollar, that's been you know, pulling back at least 200 pips. So you can use breakouts and pullbacks. So if you've got two accounts, you can trade breakouts in one account and pullbacks on the other account. So you're squeezing a trend with two different strategies. And that's the other thing, you know, as a trader, this is my business, I have multiple accounts. I don't just have one account. I have accounts for Forex, I've got accounts for stocks. I trade pullbacks in one, I trade breakouts in the other.
So where would you get out of this euro dollar position?
When it takes me out.
So you've got stopping.
Yeah, exactly. I've got a trailing stop loss. And what we look for are confluence of events. That's the term to get into a trade, right? But you can also use confluence of events to get out of a trade. Yeah, so I've got a trailing stop loss in play, and that's following price. Okay, and as you can see, it's far enough to allow for the pullbacks.
You have the trade. So you bring it in the stop.
Yeah, I'm mentally following it. If the pullback, if that current breather area goes any deeper, then I'll lock in all my profits, and if I get stopped out, I get stopped out. When it breaks 1.1, I'll get back in. Yeah. How big? Well, I mean, I want to take as much as possible. So, you know, if it starts pulling back, then I want to take at least 85, 90% of the trend. I'm happy to give back 10% in case it goes in my favor. You're not going to take the whole trend. You miss the beginning, you miss the end, you take the middle, and you compound the hell out of it. Yes, sir.
Hi, Zia. Are you not concerned that even though what you've shown us are ostensibly different financial instruments,
Yeah.
what you're doing really is buying the dollar? You're hugely at risk from a dollar reversal with so many positions that are buying the dollar.
Yes, it's a good point. But what you'll understand with trends is that this is part and parcel of trends. If you remember the Japanese yen, end of 2012, end of 2000, all the Japanese yens moved. But then I say to you, out of all the dollar crosses, how many am I trading? I showed you the Aussie dollar, US dollar, the Euro dollar, the Swedish krona. How many? That's 3. How many dollar pairs are there? See, you don't need, as an investor, as a trader, you don't need to take all the trends. You take the best ones and you manage your risk and you compound. Yeah? So you only need to have 3, 4, 5 trends a year. And if you have those in each market.
I think one more question and then we'll have to wrap up, if that's all right.
Okay. Who wants it?
One last question.
Yes, sir. How you doing?
What's up with finding trends without your strategy?
Oh, God. If you've got 26 hours in the day, then yeah. I mean, look, this is the thing. Like, good software is not expensive. I think where people go wrong is they don't want to invest in trading at all because the markets now are so accessible. You go online, you open an account, the broker wants to see your passport sometimes, and he lets you open an account. Then you've got them on the phone calling you. So just because the markets are easily accessible doesn't mean the money is. Now, if you guys think about it, before the internet, everything was done by hand. The daily 200 moving average was drawn by hand. There was no time for short moves. There was no time to get in and out scalping. There was no time. So it's no coincidence that before the internet, less people were losing money. Now, with the creation of the internet, which is a fantastic tool, has totally derailed the way private traders should be traded. And people need to wake up to that. That's my message for today, is that people need to be smarter. If you don't want to join my community and get my software, I totally understand that. That's fine. But what I would suggest is trading really for you. You've got families, you've got kids, you work hard for your money. Why blow it on the market when you don't know what you're doing? Save your money and look after your family. Do something else with it. You don't need to be wasting it in the market. This is a business that requires time, it requires education. But if you nail this, it will change your life. And it doesn't require a lot of investing. And the overheads are about $2,000 a year. Which business has overheads of $2,000 a year? My office is more than that. Thank you.
Thank you very much, Zahir and Wari. And just to let people know before they go, where to find out more information, traderscosmos.com, I think is your website, because I know you don't have a stand here.
If you give me a second, if you go to the traderscosmos.com, I think I've given handouts to a lot of you guys. Everything's on here. I'm on Twitter.
The traderscosmos.com.
Yeah, the traderscosmos.com. And actually, if you guys are on Instagram, I'd really sort of appreciate if you guys follow me on Instagram. Where are we? Like I do a lot of stuff on Instagram, a lot of stuff. So a lot of charts. Now the beauty of Instagram is that I can date when I last did my analysis. So I did a post yesterday on the euro pound, and the last time I did an analysis on that was a week ago. So you guys can see in that week how prices developed. So you know euro pound. The Instagram's a very powerful tool. Okay, thank you very much, guys. Thank you, Simon.
Just everybody at home, I do apologise for the sound issues that we had through that presentation. As I say, I'm not able to address these immediately as we go through. I'm learning all the time, but I hope you managed to catch most of the presentation from Zahir. As I say, it is recorded, so you can go back again should you wish to listen into that again. We're just going to take a short break for 10 minutes, just under 10 minutes. Our next speaker, Catherine Stott, will be giving us a presentation on breaking down psychological barriers with hypnotherapy. So that'll be starting in just over 8 minutes from now. Thank you. Okay, we're just about to get ready to start our next presentation, which is hypnotrading, breaking down psychological barriers to success, hypnotherapy for traders. I do realize we have some sound issues, but if we could just ask if people are hearing, first of all, me coming through to you okay. If you could just give me an indication in the chat box. I'd appreciate that just before I hand over to Catherine Stott from Hypnotrading.
Good afternoon, and thank you very much for coming to my talk today on the London Investor Show. Today I'm going to be talking to you about breaking down psychological barriers to success, hypnotherapy for traders. I wonder if you can ask yourself, do you find yourself deviating from your trading plan? Do you struggle with being inconsistent when you're trading? Do you find yourself exiting trades early, then realising you could have got a larger profit if you stayed in, or indeed exiting too late and ending up with too big a loss? Do you struggle to hold your nerve? These are just fewer things that hypnotherapy can help with. My name is Catherine Stott, and today I will be talking to you about hypnotherapy, hypnosis, and psychoanalytic techniques that can help you be a better trader. My background is in psychology, so you can change the slide now. So those of you who are online, you can have a little look at what I look like. I worked as a human factor psychologist before going on to train as a clinical hypnotherapist, NLP practitioner and EFT practitioner. I've got experience working with both private clients one-to-one and also in the corporate environment, bringing hypnotherapy to the workplace. I work with both UK clients and also international clients via Skype, including Australia and America. So, if you'd like to change the next slide, please, Simon. Thank you. Today I'm going to be talking to you about what is hypnotherapy. I'm going to set your expectations for what it can and can't do. I'm going to talk through popular or common trading challenges, the therapy process, and a number of case studies. I do tend to talk quite fast. I have two speeds, fast and faster. So if I am going too fast, please do wave at me.
You're going too fast.
Thank you very much. Good, brilliant. Thank you. I will slow down. You can change the slide, Simon.
Thank you.
So first of all, we're going to talk about what is hypnotherapy. And you can change the slide again. That was a big slide. Okay, so hypnotherapy uses hypnosis. Hypnosis is actually based on the Greek word for sleep, but it's not actually a sleep state. Hypnosis is a natural state of mind that we find ourselves drifting into every day. A few common examples would be if you drive to work or when you're driving home, a very familiar route, and you find yourself not remembering the drive and you think, oh, whoops, I probably should have been paying more attention. Or indeed, you find yourself reading a sentence over and over again in a magazine or a book and you can't understand why you can't just focus on reading the book rather than that just one sentence. What's happening is your conscious mind is going off into a neutral state, allowing your subconscious mind to come to the forefront and be more accessible and influenceable. So hypnotherapists are now employed within the NHS, within IBS departments, in childbirth, maternity units, and also within UK mental health charities. So it really is being recognised as one of the best therapies out there, and it can be used to overcome a number of emotional and physical conditions. So when you're in hypnosis, which is a really nice state of relaxation.
Could I ask, I can't quite hear you. I think the microphone's not working. I don't, it's
Okay.
very difficult to hear.
Shall I start speaking louder? Is that better?
I think the microphone is not working. I don't think you're not holding the microphone close enough.
I was told it was switched on. You're going to laugh at me if it's not switched on. Get closer. Okay. Right. There we go. Thank you very much for drawing that to my attention. I hope everyone can hear me now. So, once you're in hypnosis, which is just a wonderful state of relaxation, you can use that to make a number of changes. You can replace negative beliefs with more positive ones. You can strengthen existing beliefs that you've got and skills, and you can also create new skills and abilities that you weren't aware that you could have. You can also use it to release any repressed feelings and negative issues that are stopping you from achieving what you want. Okay, so how does it actually work? Many people just assume that I am Paul McKenna and in a moment you're all going to be walking out of the room clucking like chickens. But it doesn't work like that. You have to want to change. A common example is that many people say, oh, I saw a hypnotherapist for stop smoking, but it didn't work. When I ask them, it turns out they didn't actually want to stop smoking in the first place, but merely felt that they should because many people tell you, as is commonly and widely known, that it's bad for you. So with trading, clearly there's going to be something that you want to change and want to improve about yourself, and therefore hypnotherapy will work for you. How does hypnosis feel? Well, everybody experiences it differently. So some people find they feel like they're floating or sinking. Some people feel like there's nothing at all happening and they're wondering if they really are hypnotized. And for many of my clients, they experience tingling hands and feet. Okay, so in the words of Bill Gates even, success is a lousy teacher. It seduces smart people into thinking they can't lose. This is a brilliant quote and very apt for traders, because many people take up trading because they believe it's their way to becoming rich quite quickly, or at least making enough money to live comfortably. However, because they think it's going to be easy, they don't necessarily realise the psychological elements involved in trading, and trading can help with many things. Hypnotherapy can help with many things. Change slide, please. Thank you. For example, stress and anxiety. The trading environment can be a very stressful place, and how you handle that and manage that will dictate how well you trade. A fear of success, or indeed a fear of failure. Improving your belief and confidence, focus and motivation, emotional and personal issues, inconsistency with trading, as well as how you react to losing trades. Those that are highlighted are ones that we'll talk a little bit more about in depth in a moment. So how do you break those psychological barriers? What's the actual process when you go to see a hypnotherapist? Well, first of all, and the next one. Thank you. We have a consultation. Now, the consultation is an opportunity for me to find out all about you. I work one-to-one with clients to understand their trading psychology and their actual needs, and there is no one-size-fits-all approach. I'm working with treating the whole self, working out what's happening in your life, how that's influencing you, what's holding you back. What are your physiological responses when you're trading? Is your heart rate racing? Are you sweating? Are you anxious and nervous? And what are your cognitive behaviours? So what are you thinking? Are you sat there thinking, this is going really well, I am an awesome trader? Or are you sat there thinking, this is going to go wrong, I can feel it, and getting all nervous, and so it does end up going wrong? We then look at the reasons you're making mistakes. What are those mistakes, and how can you overcome them? There are a number of self-limiting behaviours. If you could change the slide for me, please. There we go. That are common within my therapy room. The first one is setting yourself a goal, and that's creating a barrier for you. So, for example, you'd like to make 100 pips a week, or you'd be happy with 10 pips a day. And you find yourself getting so close to it that you pull out of the trade and exit because you're so pleased that you've got near it, and you realise that had you stayed in, you could have made a greater profit. But every time you do that, you make the same mistake, pulling out when you've made only a small profit rather than going on to meet your potential. Knowing your methodology. Many of you will be studying hard, you'll examine the charts, you'll be talking to various different providers, and you'll be asking yourself, is your methodology right? Except for some people get so into what they're doing and the techniques that they use for trading that they stop learning, and then they start becoming complacent and making mistakes. An inability to try something new, very much linked to what I've just said. Trades going in the opposite directions to those predicted. If that's happening occasionally, then you can put it down to chance, I suppose. But if it's happening all the time, then there must be something wrong with what you're doing. And also rushing into trades. So whether that's you have this belief that you are a trader and therefore you must trade rather than taking a day off, or indeed you've incurred a loss in the previous trade and you're trying to recuperate it. So I work with clients on reframing their behaviours, looking at things differently. I work with them to help them learn diligence, to be patient, to be flexible in their approach to trading and the methods they use, waiting to trade and giving themselves permission. This is a really important element. As I said before, many people assume that because they are traders, they must trade, when actually sometimes you need to know when to walk away from the trading floor, or indeed you need to give yourself permission to actually be successful. If you could change slides, thank you. So then we go on to how you facilitate change. It's really important when looking at your trading to understand how your future and how your past influence how you trade. Who you are today is influenced by your entire life. Your values, your beliefs, your motivations have all been created from past events, whether that's something from your childhood or whether that's something from only a few months ago that's affected you. It will influence how you trade, and your goals and your visions are what drive you forward. So therefore, it's about understanding what's influencing you the most and dealing with any of those issues that may be holding you back. Some of the techniques that I use, it involves more than just hypnosis. Positive suggestion, a wonderful example of that would be how with every word that I speak you find yourself feeling more and more positive. The hypnotherapy for trading is something for you. Talking therapies, understanding what you're doing when you're trading, what's happened throughout your trading week, your trading month, and understanding how that's affecting you and impacting you. That allows me to get feedback on how I can tailor the therapy to you, but also you to understand for yourself what's happening. Quite often we just get on with what we're doing and don't take the time to analyse it. Coaching, so working out what you need to do going forward, how you're going to do it. Analysis. Another term for analysis is regression. Not all therapists are trained in hypnoanalysis or regression, and for many people it's actually a bit of a scary term. I promise you it's not that scary. Analysis is all about understanding those elements of your past that may be influencing you. Neuro-linguistic programming, NLP, a bit of a buzzword I believe in the world of trading. Put very simply, it's using the power of language to change the way you think. A fantastic example would be the word to lose. I have many clients who come and see me because they want to lose weight, but for some reason it's not happening. However, if you lost your keys or you lose money when trading, that's a bad thing. So why would your subconscious all of a sudden want you to lose anything? And so it's about reframing that to reduce your weight or to manage it. Emotional freedom technique, EFT. This is a little known therapy. It's a meridian therapy. For some people it might be a little bit out there, but the idea is there are energy systems travelling around your body. For those of you that have experienced acupuncture, it's based on very similar principles about placing needles in your skin to release those energies. With emotional freedom technique, you're tapping on a variety of points, the idea being that you can release any blockages. Some people believe wholeheartedly in meridian therapies. For other people, they believe it's a distraction technique using EFT. However, it works quickly, and it works well. Next slide, please. Thank you. So how do we put that into practice? How do we actually make sure, now that we know all this information, that you can create those changes for yourself? Next slide, please. Well, I've worked with a lot of traders. As I say, I've been working with them since 2010, and I find they fall into a number of categories. The reactive trader, the trader who makes a loss and jumps straight in to recuperate their money. The planner, who studies the charts diligently and follows what they're watching. They tend to be very successful. The risk taker, jumping in feet first without thinking. And the indecisive, spend so much toing and froing that they miss the opportunity. And also personality can affect how you trade. I use a personality method called Warriors, Settlers and Nomads, which was devised by a therapist called Terence Watts. It's well known within the hypnotherapy world, and I have an article on my website which you can look at, and I'm running a free webinar later on in the year about it. But very briefly, the warrior is the one who likes to be in control, the decisive character, the one who will pay attention to detail and does not like to lose. The settler, who likes to please people, who wants to make everyone happy and make sure that nobody's upset with them. And then there's the nomads, the kind of people that you'll catch by the coffee machine because they'll always be late for a meeting, or perhaps they're more of life's risk takers and they're a little bit more outgoing with their personalities perhaps. This can really affect how you trade. For example, warriors are more likely to be the ones who trade decisively and trade well, and then they will also get very frustrated and angry when they incur losses. The settlers will probably take it to heart a little bit more and think about the long-term consequences of what's happening with their trading plan. The nomads, they're the ones who are the biggest risk takers, and they'll either jump in feet first and regret it, or they'll jump in feet first and come out with an absolute fortune. So, do you want to trade more consistently? I'm going to talk to you now about a number of case studies. If you could change slide for me, thank you. The first one is about consistency. There are a number of behaviours that indicate that someone is trading inconsistently, but most people know whether they'd fall into that category or not. First of all, there's seeing what you want to see on the charts. For a scientist, when they're researching, they have a hypothesis of what they want to know. They then research to disprove their hypothesis. Traders tend to see what they want to see on the charts rather than looking for indicators why they shouldn't take that trade. And normally when you analyse losing trades, there's normally something glaring there that tells you that you shouldn't have taken the trade in the first place. Revenge trading, taking out your anger or frustration on the market and jumping in too quickly after incurring a loss. being overconfident. You've been doing really well, whether it's for a few days or a few weeks or longer, and then you start making silly mistakes. Nomadic tendencies, as I talked about earlier, being a bit more risky, perhaps not analysing things properly because you just can't wait to start your trading. And also problems with self-control. So I'm going to talk about a case study now of an inconsistent trader. I had a male from London. He came to see me because he had difficulties sticking to his trading plan and methodology. He couldn't understand why he wasn't able to stay in control of that and felt fearful of trading, but he was unsure why, and this fear was quite a new thing. You could click the next button, thank you. The problem? He would exit a trade partway through instead of seeing it through to the end. When the trade was going in the wrong direction, the client couldn't hold on to see if the trade would turn. The review of lost trades, there'd always be an indication why he shouldn't have taken the trade, and on profitable trades he'd exit with only a few pips rather than going on to make a bigger profit. So what did I do? Next slide, please. Thank you. I used analysis, first of all, so that we could understand where this fear was coming from. He'd previously been told by a trading coach that he was a fear-based trader. I always find it quite funny when I hear that from clients because I always want to know a fear of what. Most people assume it's a fear of losing money. This client had previously had an experience in his life where he'd experienced great loss and depression, and during that time he had been in a very bad place in his life. Whenever he was trading and he incurred losses, the emotions that it stimulated were very similar to those he'd experienced in this previous dark time in his life, and his fear wasn't of losing money. He could do, losing money didn't affect him too much. It was actually more the fear that he would ever feel that deep, dark, depressed ever again. So we went on to use anxiety reduction techniques whilst he was in the trading environment. We used suggestion work around confidence when trading so that he felt good about what he was doing. He believed in himself and what he was doing. And we used coaching. One of the things I'm going to mention here is parts. Parts therapy is one of my favourite therapies. So whenever you go into a shop, very simplistic, you see something very expensive, whether it's a car, a pair of shoes, a phone, and you want to buy it, except for you can't afford it. And you either buy it anyway and walk away happy, or you don't buy it and walk away happy. That's when the part of you that wanted to buy it versus the part of you that couldn't afford it agreed that actually you do it anyway. When your parts conflict, that's when you feel bad about your decision. Either you regret walking away or you regret purchasing it. Parts therapy when trading, the part of you that wants to win, that wants to make a profit, the part of you that is fearful of making a profit or fearful of making a loss, that stops you from staying in a trade long enough to see it through to the end. The overall result for my client, if you can click the next button, thank you, was that he began to trade more consistently. He began to make more profitable trades, and when he made losing trades, he was able to understand the decisions behind them better. He started to break his previous PIP-related boundaries that he'd set for himself, and went on to become a really good trader. Thank you. Albert Einstein said that insanity is doing the same thing over and over again and expecting different results. Many of you, I can see a few nods in the audience, will be repeating those trading behaviours and still wondering why you haven't made it yet or why you've been incurring losses. And I refer to these traders as a little bit stubborn, although stubborn might not be the right word. If you could change the slide, please. So characteristics of a stubborn trader is someone who thinks that they know the best thing to do. Not necessarily know it all, but know what they're doing. They can't understand why their methodology suddenly isn't working or has never worked in the first place. They're no longer learning about trading, about their psychology of trading, and about how they can be better at what they do. They have ambivalent emotions and are more likely to feel angry or frustrated, and they believe that what they're doing is right so they can do no wrong. I'm going to talk you through a case study now of a stubborn trader. I saw this trader quite a few years ago now. In fact, he was one of my very first clients. He had developed his own methodology for trading, and he taught it to others because it was that good that other people would benefit. However, he started making a loss when he followed that methodology, and he would find himself talking to other traders who he taught and were doing very well and lying to them about how successful he was. So he started having feelings of frustration, anger and low self-worth because he didn't know why it wasn't working for him. You could click the button, please. Thank you. So we worked on, the problem, which was he was desperate to prove others wrong. He had an element of learnt helplessness, so he would fail because that was what was expected of him. He would think that that was what was going to happen, and so it did. So he'd wake up every morning thinking, well, I've made a loss for the past 3 days, what will be different today? Rather than, what am I going to do differently today to make myself trade better? So yes, he was repeating those mistakes, and this was impacting on his life, not only in the trading environment, but also in his relationship. So he broke up with his girlfriend. He was snapping with his friends. He was a very grumpy individual. I'm sure he'll like me for saying that. Next slide, please. So what did we do? First of all, we started building on his confidence and his self-belief. We reframed it to be about proving himself right and nobody else. Essentially, if you've taught your methodology to other people, it doesn't matter what they're doing. What matters is what you're doing. You only have to prove yourself to you. We also worked on breaking down the emotional, psychological expectations set by others and dissociating emotions from his current methodology. It was his baby. Of course, he's going to be fond of it and want to work for him. But if it's not working, sometimes you just have to learn to move on, and that's something that we worked on together. The result? Thank you. First of all, he began to realise that he could never stop learning. He didn't know it all. He wasn't one of the world's great traders who publish books and make multi-millions on just 1 or 2 trades a week. He ended up moving away from his own methodology to one where he'd started trading better. He began to reduce his losing trades, not only in quantity but also in value, and also improved his profitable trades month on month. He learned to reevaluate his goals each month. Many people forget to set themselves goals, but trading is like any business. You need a business plan, you need to know what you want to achieve and how you're going to do it. Next slide, please. In the word of Oscar Wilde, I don't want to be at the mercy of my emotions. I want to use them, to enjoy them, and to dominate them. Just think about that for a moment, if you will. Many trading psychology textbooks, many of the world's best traders will tell you that you have to trade without emotion, that you have to be able to switch off that part of you that feels. I disagree. I think, and I believe wholeheartedly, that it's about managing your emotions. Emotions are there as an indicator that something is happening in your environment. It's giving you feedback. So, for example, before I came up here today, I was feeling a little bit nervous, but that adrenaline has meant that I've been able to come up here and feel very excited about being here today. It also means that I speak very quickly, but I am working on slowing that down. So how do emotions play a role? Next slide, please. The biggest one is fear. Everybody knows about fear in trading. It's in all the books, it's on all the websites, and every single trader will talk about it, or not. So first of all, the most common one, or the most one that people think about, is the fear of failure. So first of all, that could be to do with losing money. It might be to do with not succeeding in life. Perhaps you've had other ventures that have failed, and if you don't make money with trading, you're failing at that too. Perhaps it's the impact on loved ones. So if you're trading for a living and you don't make enough money, how will you pay your bills? Perhaps it's hearing "I told you so" from other people. Then there's the fear of success, something that many people assume doesn't apply to them. After all, wouldn't we all like to be rich? However, many people can't actually handle being rich, hence why there are many people who have gone on to win the lottery, and then you read about them in the newspapers months or years down the line, and they've squandered their money because they just can't cope with the psychological impact of being rich, and also the pressure that comes from people, your loved ones, your friends, who all crop up to have some more money from you. So it's about the pressure to achieve, expectations financially that are put on you. After all, if you're making money, you can afford to pay for private schools, for example, or really nice holidays, or bigger houses, or better cars, whatever it is, whatever your motivation. And again, the impact on loved ones, if they're expecting you to be able to bring home lots of money all the time, and you have to occasionally disappoint them, or indeed you feel that you have to do that when actually they're not expecting that at all. So I'm going to talk to you about a case study now of a trader that I worked with who we call a fearful trader. So my client had been on a wonderful winning streak, and all of a sudden he started incurring high losses. So he'd either go through the trading week making good profit and then have one trade that would wipe out his whole portfolio, or he would just continually lose and make high losses. He would misread the charts, he'd make silly decisions, and he would incur large losses, but he did not know why. The problem? a fear of success. He was being put under pressure. He had siblings who'd previously let the family down, and he was always being told that he would be the one to succeed. He was the one who had to do the family proud. He couldn't balance the fear of success with his desire to achieve great things. After all, you become a trader because you want the success, you want to make the money, and balancing that was becoming quite difficult for him. He had begun to feel incredibly stressed whenever he was trading, and the better he was trading, the more stressed he felt. Next slide, thank you. The resolution. First of all, we did some analysis work to understand his emotions while he was trading, when he was in profit and when he was losing. Out came a lot of things about his childhood where he was told, as I mentioned previously, that he would always be the one to have to prove the family was good. You know, he had a brother who had not done so well in life, and all the pressure was being put on him, and how he could let go of that and move on. We did some NLP work on letting go of the pressure that he was feeling, and also bringing in positive emotions associating with good trades. So why he wanted to be a trader in the first place, and working with that on his self-belief. Once again, you only have to prove yourself to you. Self-worth, confidence and belief is all about you and what you can do. And the result, he was able to walk away from trading when he was not in the right zone. A few people have actually asked me today about that element, about how, you know, they might be making 1 or 2 losses, and then they continue to trade when they know actually what they should be doing is walking away from it and saying, I'll come back tomorrow. So we had to work on that and walk away, yes. Lost my words there, thank you. You also can work on identifying an off day before it happens. We began to reduce his losing trades, and he began to make more profit on the trades that he was making less profitable and reducing the losses. He was also accepting and realising that you cannot be responsible for other people's happiness. So there's a lot of other things involved within trading psychology other than just trading. It's your family, your life, your history, your future, your relationships. So, profit is inevitable. If it wasn't, you wouldn't trade, but so is loss. And how you react to losing trades can impact how you go on to trade in the future, both the short term and the long term. Common reactions to losing trades are anger and frustration, revenge-based trading, taking it out on the charts, reactive trading, which is similar to revenge trading but is more sort of jumping in without thinking about it first, feeling panicked, getting feelings of anxiety, depression, low self-worth, but also sometimes feelings of relief if it's linked to a fear of success, for example. So I'm going to talk to you now about a trader who continually had negative reactions to a losing trade. I had a lovely female come to see me. She'd begun to feel very depressed when she was trading. Every morning she would wake up and she would feel anxiety in that pit of her stomach about reading the charts, about making her preparation and taking those trades. Her depression was impacting her relationship. She was shouting at her children unnecessarily, and the doctor had advised her to take antidepressants, but it wasn't a route she wanted to go down. The problem? Thank you. Negative self-talk. She would be sat there saying to herself, this isn't going to work, it's going to be exactly the same as yesterday, I'm useless, I should be good at this. She had a complete lack of focus when she was trading because she was too busy telling herself she was not good enough. And therefore she was consistently validating her feelings of low self-worth. She had a huge sense of relief when making profitable trades. However, the depression when incurring losses was something that crept into her everyday life. So what did we do? First of all, we used anxiety and stress relief techniques that she could use live whilst trading. We worked on her mental preparation for the day using positive affirmation. For those of you that don't know, an affirmation is a sentence that you can say to yourself about the present self that you're in and how you want to feel. So for example, I am trading well. I am a good trader. So you're not talking about the present tense and what you want, you're talking about now and what you are doing. That's a very basic example and something that I'd be happy to talk to you more about offline. We also did some analysis to understand why she felt so bad about herself. It turned out that despite being academically excellent, she had A's and A stars at GCSEs, A's at A level, a first class degree, perfect in all financial areas. She should have the recipe for success. But she had always been told by her parents, who are those people in your life who create those foundations for you that she would never be good enough. Whatever she did, she would never be good enough. And despite the fact that she knew she was an academically excellent, she went on to believe and carry with her what she'd always been told, that she just wouldn't make it in life. So, where have I got to? Oh look, there I am. So we then went to work on her self-esteem and her confidence, and actually letting go of those feelings of being not good enough, because it just was not true. The result, she began to trade better in general. She felt calmer in the morning, she let go of the anxiety, she actually approached her trading day feeling more like, actually today is going to be the day that I trade well. She let go of those feelings of failure and measured her success by what she was seeing in her family life and in her trading life. After all, she had a fantastic husband, beautiful children, a good house, everything was going well for her, so why shouldn't she trade successfully too? Her losing trades were met with a positive attitude of understanding why didn't she make a profit, what had gone wrong in the first place, and what could she do differently. So she also started improving her decision making. So this all sounds really good, but many people actually ask me, does it really work? Well, I wouldn't be standing here today if it didn't. And here are a few quotes from some clients. Catherine really made a difference. She's helped me focus, stay disciplined, and expect the success we are all capable of. My trading has turned around 100%. I'm making consistent profit based on logical decision making and calm trading. You can read the others for yourself for a minute. Actually, since telling previous clients that I've been coming here today, yesterday I started receiving text messages from them wishing me luck, saying how much I'd changed their lives and how much they've been able to turn their trading round and go on to be brilliant traders, and that, you know, they believed it was me. It's not me, it's them. I'm merely facilitating the change. I'm merely helping you with meeting the goals that you have. So my message to you is welcome to the power of your mind. You all have it within you to be a success as a trader, whether it's a success that you're earning hundreds of thousands of millions, or whether it's that you're making enough money to be living comfortably, whatever success is to you. Today, I'm on stand 10, and I offer a range of hypnosis CDs and MP3s that you can come along and purchase if you like. I'm also running a webinar about trading personality types, which I talked about earlier, and also looking at various different techniques that we can use in different situations. If you'd like to come and talk more, if you've got any questions, I'd like to thank you very much for listening, and I welcome your questions now. Thank you. Oh, there we go, that's better. I have a clinic in Wokingham, but I also offer sessions via Skype as well, so if it's a bit too far to travel, then Skype is a good option. Like I said, I've had clients travel down from Manchester. I work with international clients as well, so Skype's a brilliant option if you don't want to come into clinic. It really depends on why you've come to see me in the first place. So for some people, 1 or 2 sessions is all they need. For other people, they might need 6 or 7 sessions. It really just depends on the complexity of your needs and what's influencing your trading challenges. They're about 45 to 50 minutes. I also do double sessions as well, because obviously some people travel quite far to come and see me. And if you've driven for 5 hours, you don't really want to be there 45 minutes and drive off again. Any other questions?
You call this hypnotherapy, right?
Yes.
But it's not just hypnotherapy. You do NLP, EFT.
Yes, that's right. I do a variety of different techniques. I call it hypnotherapy because I use NLP, EFT, psychoanalytic techniques within the hypnosis environment as well as outside of. So if it's not relevant to be hypnotized for a particular session and we can do it outside of hypnosis, then we do that as well. I do get clients running around the room doing different things, not running around like chickens, I hasten to add.
Okay, I think we'll have to draw it to a close there. I'm afraid we've got another speaker. Thank you very much.
Thank you.
Hypnotrading.co.uk. And again, if you'd like to talk further, Catherine's going to be on stand 10 in the Westminster suite. Thank you very much indeed. Thank you. Just leave it on. Yeah, just leave it on. No. Great.
Thank you very much.
We're just going to be coming back to you in about 2 minutes, starting with Tom Trajan from Forex Roundup.
Today, I'm going to be showing you how I look at studies, both technical and fundamental, in order to arrive at having the right positions for the big moves. I'm not going to look at the short term here. This is ultra long term, and I'm going to keep it simple. There's a lot to get through. We've only got half an hour. So some I will skip a little bit fast, but don't worry about catching all the slides, because I'm sure you'll be able to get a copy of those at some point later on. Okay? You could roll forward, please, son. There's a little bit about me. I've been doing this for quite a long time. Next slide, please. Using my techniques and studies that I outline, these are just some of the moves you could have made in the last few weeks, profits you could have had. There's many more, but I've just highlighted these three here.
Can you hold the mic?
Of course.
Sorry to get just for the people at home.
It's quite heavy, actually. Right. Does anybody answer that question by any chance? It's pretty simple. Next slide, sir. It's all about timing. Everything in life is about timing, as I'm sure you're all aware. In foreign exchange, it's crucial. I don't just rely on technical analysis, okay? Look at the fundamentals as well. I use the technical analysis to complement my fundamental view. Those are the key points I identify as a fundamental analysis that you need to be aware of. Remembering that currencies are in pairs and it's all relative, okay? So it's a relativity study between weak and strong. Next slide, please. Again, these are all part and parcel of the fundamental study, right? There's one key thing you can do to help you with that. Obviously, you need to be aware of the news. You need to look at what's going on around you. You need to have a global view on what's happening. We're all intelligent people. We can all make our minds up on that, okay? Next slide, please, Simon. That's one of the cheapest and easiest ways for you to do your research. You don't have to buy it every week or every month. but just buy it now and again and flip to the back 3 or 4 pages. Okay, they'll give you all the relative details and data you need to look at as to which economy is doing well and which isn't. I can't emphasize enough how important this is. Okay. My view on all these things is don't overcomplicate it. I'm sure today you're going to be bombarded with various different studies and technical analysis studies for how you can trade both short and long term. I like to keep this really, really simple, because at the end of the day we're talking about a simple aspect here. We're talking about a move in one direction or another, and what you want to do is catch that big move. Okay? Next slide, please, son. These are the key areas that I look at. Okay? There are other things, but for the purposes of today, these are the key studies that I watch. We don't look at anything else. Okay? Trend lines and channels, support and resistance lines, pennant and wedge formations. I'm going to show you some really interesting ones of those in a minute. Moving averages. Has anybody heard of the Golden Cross? Okay. Double tops and bottoms. We'll see some good examples of how that's formed at key levels of trend changes as well. Head and shoulders formations, when they come along, they have to be respected. And the Fibonacci and Elliott wave study. I'll have a little bit of a look at the relative strength index as well. Here's one that's playing out live at the moment. It's a classic downtrend channel. It's fairly shallow. It's Euro Sterling. I've been telling all my readers for months now to be short of this and stay short, and the price is still edging lower. I think we've got pretty good potential, certainly towards 70. A lot depends on what happens today, of course, and I'm sure you're all aware with what's going on with Greece and the ECOFIN. But at the moment, the trend is still live and still heading towards 70 cents. Okay? It's still a sell on rallies. It's still heading towards the end of that channel. I wouldn't look too much beyond 70 at the moment. Okay? Here's a classic example of an uptrend channel. This is a long-term uptrend channel for dollar yen. Also on here, I've marked a 5-wave Elliott wave study as well, which is one of the best I've seen for a long, long time. And I was able to identify this fairly early. We had wave 1, which started back in 2012, correction wave 2, explosive wave 3, textbook correction, 38.2%, which was actually nailed quite early. For wave 4, consolidation, then a breakout wave 5. Now on the next slide, I'll be able to show you some actual pennant formations which really help you identify this as well. So if we could move across, Simon. So you can see the first breakup where wave 3 took off from the first pennant wedge breakout back in 2012. Again, we had wave 4 consolidation, the second pennant wedge formed, and then another breakout. These are easy to spot if you lose the long-term channels and you sit back and you take the time to do it. Okay. Wave 5 is slightly awkward in the sense that it had a long period of consolidation before it finally broke. And you can see through that green line I've drawn there, the resistance and the breakout, subsequent pullback to the resistance at the line, and an explosive move back up through 110 towards 120. Now, I feel at the moment that this 5-wave sequence could have concluded, okay? It looks to me like it has. If it breaks 122, then I feel obviously that's got more upside extension. And at the moment, you can see for most of this year, we've been trading 115, 120, and we're consolidating while the market decides whether there's further upside or not, okay? What I could ask, actually, Simon, I'm going to walk across the picture. I could use the clicker, actually. If I could just borrow that 1 minute. There. Okay. Can we move to the next slide, please? Here's where I've actually blown up that wave 3 pennant breakout, wave 4 pennant breakout rather. And you can see blowing it up on a slightly shorter time scale gives you a much clearer definition, okay? These are really explosive. They normally go towards the end of the wedge, okay? They don't always work, and they do sometimes give you a false signal, but using this in conjunction with that longer-term 5-wave study gives you an ideal entry point where you know, look, this is going to break. It's been consolidating for a long time, it's going to break. Subsequent break up, okay? Next slide, please. This one's actually on oil, but again, it's a classic example of this wedge formation where we had a lot of consolidation for 1 or 2 years there, but when that move unfolded, it broke the wedge, massive acceleration. It's a hell of a move, okay? Hell of a move in pips terms, yeah? We're talking about 50% drop. So yeah, I hope you can see that, you know, if you use these, you can identify some seriously good moves here. I know this one is oil, but the same applies to whether it would be dollar, yen, or euro. It's exactly the same. And I'll show you that on the next slide. This one's actually euro dollar. Again, same sort of pattern. I hope you can see a pattern emerging here, everybody. Yeah? Got upward pennant wedge, slight sort of consolidation with an upward sort of almost trending upwards, and then the breakdown. Now, I told all my readers when 135 broke, just get the hell out of euro. Do not be long. And I have been short all the way down to 115, okay? So this is an example of where you use these longer-term formations to identify a trade that you can stay in. If at any point this breaks back up inside the wedge, you just simply get out the trade, okay? But this should give you the comfort and the knowledge to realize that you've got a move on here, and the chart is telling you what could happen, okay? If we move to the next slide, please. I'm going to talk about Golden Cross now. I know a couple of you said you'd seen those before. I use these a lot, normally only on weekly charts. I don't use them on any closer time frame than that. And the textbook definition is I use a 30, 90 and 200 day. I don't mess around with 1500s. 30, 90, 200, if you can remember that. It works really, really well. Obviously, the textbook example, as you can see there, is when they both cross through the 200 day at the same time. That's the 1390. Okay? It's giving you an idea of trend direction, which is what you want if you're going to catch the bigger moves. Next slide, please. Here's a good example of that. This is dollar yen. You can see this golden cross here, right back here below 90. Now, it would have taken a little bit of time to unfold, obviously. Price action would have been above the 200 day before these crossed up. But you can see, obviously, the potential here. It's explosive. It's a big move, okay? If you're going to use the golden cross, do it on the weekly, all right? And do 30, 90, 200 weekly, okay? That's my advice, if I'm allowed to give such things. Okay, next slide. Another example of that. This is a long-term 5-year weekly chart, Sterling Oz. Again, similar formation. Breakout, price action above the 200 day, both crossing almost at the same time. Not exact, but almost. Simon? Now here's an example of something that unfolded in January, and I was very, very bearish on the euro, particularly even again when this happened. This is a 200-month moving average. That's a hell of a long time, okay? 200 months. We closed on the 31st of January below that 200-month moving average. You can see where we sort of tested it, but not closed 3 times. That close was the biggest indicator I've had, apart from the trend channel and wedge breakout downside, for an extension of this move. And you can see it's pretty much still there from when I did this slide, around 113 today. Unless the price breaks are back above there on a closing basis, the trend is still down, okay? It's still down. Next slide. Just to look at double tops, a classic example of a double top. I know this is an old chart, but it's still relevant in the sense that we're looking at the study, not the actual chart or the actual time frame. Top 1, top 2, it's dollar Aussie, Aussie dollar roller, peaked out, bang, still heading down here now. Well, actually, it's probably down here somewhere now. So it's just a classic example where a double top gives you the indicator of trend exhaustion, okay? Now this is an uber old chart, but it's the best example of a head and shoulders formation I've seen in all my trading career, okay? What we have here is double-headed left shoulder, double-headed right shoulder, head, neckline, test, break, okay? Subsequently, textbook, if you've read your textbooks, you'll know that very often a head and shoulders formation is followed by a test of the neckline before the move ensues further down as it did. If you see one of these on a weekly or a monthly basis, do respect them because they really, really do play out. They don't always work, nothing's ever certain, but the break of this neckline was the first indicator that there was a serious move on. I actually sold aggressively through this. I know it's like a decade ago, but it was a great trade. And the reason why I say I use it is because it's the best example of one I've seen for many, many years. But you need to look at these on the longer term time frame, okay? You get these all the time on the hourlies and 5 hourlies. They don't always play out, okay? The weekly charts are generally more reliable, okay? And why you're here today is you're looking for the big moves, aren't you? You're looking to get on a move that's going to run 1,000, 2,000 points. This is a great indicator if you see one, right? 100 times out of 100, I will act on a break of that neckline, right, without fail. Next slide, son. It's a quick look at some Elliott chart and Fibonacci studies, okay? This is Sterling Oz, still playing out as we currently talk. Had a wave 1, correction 38.2, classic. Not exact, but close enough. Breakout, wave 3, still in process as we talk, okay? Still headed towards 210, perhaps even 220, okay? Currently we're not there. We touched 2 the other week, but we're slightly off there now. But my view, wave 3 is still playing out. We've got higher projection up here. Here's again, start of wave 1. We know that was the start of wave 1 because it was an all-time low. So we know that's a correct wave count, okay? The thing about getting these wave counts is you've got to catch them at the right point. You can easily get a missed signal or an erroneous signal, and you can start your count in the wrong place. If you do that, then you're going to come unstuck. Where it really works very well, particularly on the long term, is if you're trading off all-time highs and lows, okay, from a starting point. Remember that, please. Okay, next slide. Here again, this is Sterling CAD. Got that pennant wedge I showed you before. The breakout indicating the start of the move, okay? Again, this is a long-term chart, but still we're in wave 1. We're looking for a possible wave 2 correction, okay? This was done a couple of weeks back, but it's still playing out. So I'd look for a wave 2 correction to come back, followed for a wave 3 explosion higher, a lot higher. Next slide. Here's that Sterling CAD again, okay? Here's your pennant, here's your breakout, wave 2, wave 3, okay? This is updated, all right? So you can see we've had the correction, now we're in wave 3. Okay, it's unfolding as we speak, all right? Target is very steep, so it's hard, but it should be at least as long as wave 1, which is probably going to take us up to around 215, that sort of level, okay? That's what I'll be looking for. Next slide, sir. Here, classic. You can see this blown up. There's your projection. There's your plot. Wave 1, correction, bang, 38.2. Breakout, above the top of wave 1. Off we go. It's scary how steep that is, okay? Very scary. This is dollar CAD, okay? I think we may have peaked at 128, I'm not sure. But I look for a wave 4 correction from here to probably move us back towards 120. That should be followed by a final wave 5 up here well beyond 130. Okay, this is still playing out as we speak. Next one. Just a quick talk about relative strength index. I know you're probably all familiar with it, but it's a simple barometer to give you an idea that if you're looking to enter a trade, perhaps you may be in at the wrong time. Just check it, particularly on the long-term weekly and daily charts. I wouldn't look at it in the hourlies or anything like that, but you know, from a longer-term perspective, yes, it might just help you avoid getting in too early to a trade and allow you to think, well, actually, there could be a chance of correction here, I'm going to wait. Okay, just remember, RSIs can't go below 0 and they cannot go above 100. Okay, and the other key thing to remember about RSIs is that they don't have to have a corrective move. Correcting an RSI can be done with consolidation. It doesn't have to mean new price action. Okay. Right, this is the dollar index unfolding as we're here today. Very long-term chart of the dollar index, and it's broken a key trend line here. Really has. Okay. Sorry, this is euro dollar. I'm talking about. You know, it's a volatility index. I can't actually see very well from here, so I'm getting my slides jumbled. So you can see that we've got a huge increase in volatility here. That's telling me that we could, if we start to move up towards 15, towards 17. We're going to see some explosive moves on this one, which in effect is probably, you know, endorses what's going on with the geopolitical situation with Greece and Europe. Okay, so I'd look for further volatility based on that chart. Okay, next slide, son. Sorry, this is the one I started talking about before I realised I was looking at the wrong chart. Right, this is the dollar index. This is the breakout here. This is the all-time high, all-time low. So we know we've got a fairly accurate guess at starting our study here. We've reached 95.40 odd. That 50% retracement is around 95.80. It's possible that we could have a correction from here, taking us back towards 90. If we do, I'd look to buy the dollar index vis-a-vis sell euro if we do get that correction for a further move up. My view on the dollar index is we're going to go back above 100 at some point. It may take a few months, but I think that's the way of it. That's the trend, okay? Again, an even longer term chart of this, you can see this significant downtrend line in the dollar index. Okay, it broke last year. It's still rising. And what I'm trying to show you here is to look at the potential, okay? A lot of people think, oh, the dollar's overcooked, but actually, well, look where it's come from. There's a lot more upside here, okay? From the longer term perspective, that first 38.2 retracement target doesn't come until nearly 110, which from here is probably in excess of 20 big figures in terms of euro dollar, okay? If we touch that line, okay, was it saying is there? It's 106, I think, yeah?
Yep.
So, you know, from current levels, that's around about 1,100 index points, which would be, on my gauge, around about 2,200 euro dollar points, okay? So if anybody thinks the euro is looking a bit cheap, think again, okay? Because it's not, all right? In fact, I was talking to people recently, some guy said, look, euro's at record low at, you know, 110, 111. It's not. It traded to 82 cents back at the beginning of the millennium. Just remember that, okay? Right, next slide, Sloan. Here's a bit about what I do, okay? What the service is, okay? I basically try and cut out all the white noise. I'm sure you read and listen and look at stuff that you get every day and you're bombarded with stuff that you think, oh God, you know, where do I go with all this? What I try and do is cut through all the chaff, okay? Here's a plug, shameless, okay? Shameless plug. If you want to sign up, you can. I think this is the value of everything we offer, okay? You can use that website. We'll see Sarah at the back when we finish. Next slide, Tom. So you go, £1, all right? Why £1 and not nothing, I don't know, but that's not my discretion, okay? But please, if you're interested, you can have a look at it, see what you think of it. If you like what you read, you can stay on, or you can just go away after 30 days, okay? All right, that's it. That concludes what I've had to say today. I'm sure it's a bit short and sweet, but I'd like more time, but unfortunately I've only got half an hour, so I may have a couple of minutes for a couple of questions if anybody wants to ask anything.
Any questions from the room?
Anybody got a question you want to ask?
On the charts you showed, it was 1 week or 1 month period. How do you plan your entry into the trade on a short-term
On a short-term period?
Yeah, what do you do for short-time periods?
Well, I only really look at what we're talking about here in terms of long-term moves. I'm looking at the weekly charts, yeah? In terms of a short intraday trade, is that what you're looking at? Well, that's really not what I'm talking about here today, to be quite honest. Yeah, yeah. The biggest problem that a lot of people have with the longer-term trades is they place their stops too close to the market. Okay? This is something you have to be very aware of. If you want to stay in a trade for long term, what you need to do is do your studies and your analysis and realize the potential, and then don't worry about the short-term move, okay? I recently was at a conference for my subscribers, and I said to them, look, if you had 200,000 in your pension pot and you watched it drop 10% because equities dropped, would you cut the position? No, most people wouldn't. They let it ride because it's a long-term trade. You've got to look at foreign exchange in the same way. But unless you do your analysis and your studies properly, the chances are you'll probably be taken out of the trade because you'll have doubt, yeah? So what I'm trying to get across to you here is to look at foreign exchange from a longer term perspective as an asset class, not as a punt. Okay? Weeks, months. Yeah. Correct. I mean, unless you're sat in front of the screen waiting for the next bit of news and everything that's going to happen, you know, what do you want to do? Do you want to make some serious money out of a long-term position that you've tucked away that isn't of a size that's going to hurt you, where you can actually say, well, look, I'm running this because I believe in it, and it's the right trade to have, yeah? Because technically I can see what's happening, and I believe there's potential for this trade. It may be easy for me after 35 years to say, I can do this, but actually, no, you can do it too. It depends what you want to achieve from what you're doing, yeah? No, to be honest, I don't day trade that much, right? I do a lot of options day trading. I do some punting, but what I try to avoid is over trading on a daily basis. Just that basically buggers up my long-term positions. Yeah, I want to avoid that at all costs.
Got a couple of questions from the webinars if you're able to address them. Dan's asking, do you use ticked volume or any other forms of volume in your trading?
From a long-term perspective, no. Simple, one-word answer.
John's asking, how long does your £1 buy you membership of the newsletter?
5 minutes.
5 minutes.
No, it's 30
Still
days.
a good deal.
30 days.
30-day trial. There we are, John. And how does algorithmic trading affect your strategies?
From a short-term perspective, it does nothing but wreak havoc. Yeah, a longer-term perspective, it doesn't matter. Okay, the longer-term, bigger money is not interested in that sort of stuff. Okay.
Okay, thank you.
So you're actually talking about stops that look at, say, 500 pips or even more?
Well, what I try and do is fine-tune them, and I mean, you know, don't take this the wrong way, but I try and tell my readers where I think they shouldn't be in or out, okay, of a trade. That's why, you know, I'm not suggesting you have to take my service, but, you know, fine-tuning entries is the hardest part of getting a comfortable position, okay? It could be I don't put stops on some trades. I don't put a stop, yeah? I leave a call level with the broker and say, look, if it breaks that level, I want to know. Otherwise, I'm not. All part and parcel, if you want to be in for the longer term, you can't be too close to the market. Yeah.
I have a question from the folk on the webinar. How do they benefit from the £1 offer? Do you know how they can access that without physically being here? Is there someone that they can email?
Yeah, I think they can get onto the website. Is that correct, Sarah? Yeah, it's on the slide. If you go back, Simon, the web.
So
Go back a bit. It's at the bottom of that slide.
So if people on the webinar, you just go to the website forexinsiderdaily.co.uk, you'll be able to get that set up to get the £1 offer for the trial. There we are. Okay, well, thank you very much, Tom. And there's a stand in the Westminster Street as well. If people want to come and see you afterwards, Tom's going to be on the stand for a wee while. I'm presuming to answer any more questions, but.
Yeah, also Sarah's at the back there. If you want to see her, she's got some leaflets that you can grab. Okay, but thank you very much.
Thank you. We'll just be moving right along in just another 3 or 4 minutes with our next speaker, Rob Conville, the lazy trader. He's going to be talking about his lifestyle trading for you. So you can just take a break for 3 or 4 minutes, and then we'll be right back with Rob Conville. Thank you. Okay, welcome back. I'd just like to introduce our next speaker, to hear you in the room as well, not just talking to the people at home. Our next speaker, Rob Colville from the Lazy Trader.
Thank you very much indeed, and thank you for inviting me here today, Simon. Much appreciated. Good to meet you all. Thank you for all coming. My name is Rob Colville, and I run a service called thelazytrader.com, which essentially is dedicated to set and forget trading on the daily and the weekly time frame. I used to, when I was learning back in the day, I tried intraday trading. It didn't work for me at all, and I made every single rookie mistake in the book when I was learning back in 2006, 2007, until I established and discovered a style of trading on the higher order time frames, which essentially enabled me to put my trades on autopilot and to really kind of integrate trading into my lifestyle so that I could just trade on the side and just lead a happy and content life without worrying about what's happening on the charts. Okay, so I haven't always been a trader. I used to be a journalist back in the day until I moved to London. I'm from Cornwall originally, but rapidly discovered that unless you're into milking cows, picking flowers, or talking to God, there's not really much there to do for your ambitious graduate in Cornwall. So I moved to London, became a journalist, didn't really pay much money, and discovered trading, like I said, and arrived at the style of trading which really enabled me to live a good lifestyle without really having to watch the chart all day. Because face it, we all want to trade profitably, but how you do it is crucial. Intraday traders, I've got a lot of respect for them, but of course, the amount of time they spend in front of the screen, really, does that equal time for money? If you compare that to a style of trading where you're simply selling your trades up and walking away, then that's where the synergy is, where you've broken the time-money link essentially. Okay, so today what we're going to do is we're going to talk about why 92% of traders fail, or what you can do essentially not to make the same mistakes. We're going to talk about lifestyle trading. We're going to give you a strategy as well for you to take away, and a way of identifying setups, managing the setup, and of course getting used to the psychology as well, because that's as important. It's like the ingredients in the pie. Okay, if you've got any questions along the way, please just put your hand up. It's absolutely fine. I don't bite hard. So there we go. This might come as a bit of a shock to you. It wasn't very welcome news to me back in the day when I was learning. Even a broker off the record confirmed it with me. I can't tell you which broker or who it was, but he actually said that 90% of his clients lose 90% of their money in 90 days, which is a pretty shocking statistic. Anyone here surprised to hear that? Okay, well, I guess to say we've all been there at some point. Okay, so you might be asking, well, why is this? Well, there are a lot of rookie errors that traders can make, okay? A lot of it's down to not having a strategy, not knowing what to do and when to do it. Trading off emotion, they might feel lucky, they might be trading off a punt. Not risk managing. There are a lot of people who start off trading with a smaller account, because if it's a smaller account size, they essentially risk a lot more than they would and end up blowing their accounts. That's a big one, huge one actually. The fear of missing out if they're not in the market, that again is a huge rookie error, whereas anyone who's endured the battle scars throughout trading or had any experience or formal trading will tell you that sometimes it's the trades that you don't take are the ones that pay you the money or give you the money. And there's absolutely nothing wrong with sitting out and not having a position open. Okay, overtrading is a big one. Managing expectations. This is enormous, as I found, certainly with mentoring people throughout the past 7 years. Really having realistic expectations as to what trading can get you. This is crucial. Certainly the strategies which I teach are not get rich quick. I know some people, when I tell them that, their face falls and they think, what do you mean? But you've just got to let them down gently and say, if you're after slow, consistent gains, then set and forget trading is for you. But if you want a quick buck, then William Hill is just down the road. And anyone who's traded for a while and knows about risk management and goes back to any bookie shop will realize that the odds well and truly are stacked against you in a Ladbrokes or William Hill, any betting shop for that matter. Okay, so financial market trading can be very straightforward with a high reward risk potential strategy, and I'm going to teach you that in just a second. Okay, also where a lot of people go wrong is having blind faith. It's like following the leader, the blind leading the blind. You see where I'm coming from. just taking tips from tipping services with no real track record or credentials. And of course, this one, I think we've all fallen for this one, buying into magic bullet EAs which promise the earth but deliver nothing apart from a black hole. Okay, well, I don't know if any of you have gone through this. I can certainly say that I made every single mistake in the book when I was new to this game back in 2006, 2007, and I'm not ashamed of it. It's molded me as a trader, and I'm somebody who will confess and put my hand up immediately to learning the hard way. I'm quite a stubborn individual, and I will do things the hard way. This is why I mentor people, so that they don't essentially have the same painful journey as I had back in the day. Okay, so essentially to prevent... Yes, sir? Sorry. This is better. Okay.
You can stand up maybe behind the lectern. Just
the other side?
No, the stand up on the...
Okay. That's actually a better idea.
Yeah.
That's what it's there for, isn't it? You can tell I don't do these things often. Okay, so a battle-tested strategy, following a set of rules, not getting into the market based on emotion. Now, this is a big one. Being mechanical in your approach in the market, having a logical strategy which you understand, which essentially doesn't have any emotion to it. Because when we get emotional of our trading, this is when logic goes out the window and you're going on gut emotion. Okay? Keeping the risk small per trade, no matter how good it looks, always risk a small amount of your trading account. I never risk more than 2%. I say to people before they're profitable, only risk 1%. Keep it small, so that worst case scenario, you only risk 1%, unless we have a black swan event like the SMB. But that's a whole different topic, which happened back in January. Okay, only trade when there is a setup. Have confidence in your ability and your status that if you're out the market, think of the money you're preserving from not trading for the sake of trading. And this is a huge one. Have a punishment and reward system. So if you're following your rules and you're successful, reward yourself by something which you'll feel the tangible benefits of. It could be chocolate, it could be a day out at a theme park, whatever. Use your imagination. But if you find yourself breaking your rules and overtrading, have a punishment system so that you really do feel it. And this is where it's always good to be accountable to somebody else, like a loved one or a trading buddy. So they'll keep you accountable. I keep my students very accountable in this respect. Okay, overtrading, we've just covered that one. Managing expectations, appreciate that trades, nothing is guaranteed in the market. Anything can happen at any time, but you have to execute your strategy as and when a setup which follows the rules occurs, and stay out the market when it doesn't. Very straightforward. Ignore CNN, Bloomberg, the Financial Times. You can be rest assured if they've got something to recommend, it's already been factored into the market 100 times over. It's too late. The market's already reacted to that. The news has already happened. You're out in that sense. Okay? And do not buy into anything you do not understand. It's absolutely crucial that you have a strategy which you have faith in and you understand. No point in just jumping off a cliff, metaphorically speaking. Okay? So with lifestyle trading, you can achieve all I've just mentioned and many more benefits. Okay? It's the difference between staying in front of your computer, watching your trades, watching every flicker of the market, and feeling the emotional kind of trauma that goes with seeing your trading account going to positive and negative, versus someone who's just simply accepting what can happen, best case scenario and worst case scenario, and they can just be far removed in the meantime and let the trade play out without them, and they can just go about enjoying life regardless. Okay, and that's very important. If you've just got your trades on autopilot, working in the background, then you have nothing to worry about, especially when you've accepted the risk and the reward element to it. Okay, so lifestyle trading has many benefits. It frees up time, means that you're not tied to the desk. You can do it from as little as 10, 15, 20, 30 minutes a day, and you can just have it as a hobby in the background. Okay, it doesn't have to be complicated. You do not have to be in front of the screen all the time in order to do this. You can take advantage of bigger moves in the market, trading the daily and the weekly. You can be in the market for a much longer time. Like, for example, the FTSE. I know it's the Forex seminar, but all the strategies we trade work on all asset classes. We've got to trade with that Aussie yen and the dollar yen, which has been printing money for a very long time, as was just discussed in the previous seminar. It's something which has been working well for a lot of people, hence the steep trend. Okay, so it enables you really just to free up time, and we're only on this planet for a limited time, so there's nothing wrong really with just having something in the background. Treat it as a business, okay? Because if you've got a smaller account and you're swapping your time for money in the daytime, watching your screen, intraday trading, frankly, where's your time for money return? That's the difference. All too often I come across people who say they want to be a full-time trader, and I'm like, great, okay, well, how much are you trading with? Oh, £1,000. But how are you going to get, even if you're making 10% a year, which is a very respectable return, $100 is not going to look after you over the year, is it? That's the thing. Okay, so it's very important to have those expectations managed, and financial markets trading is an industry where a lot of people do have misconceptions. Very easy to go wrong. Okay, so I'm going to talk to you about a strategy which essentially you can apply to any asset class, theoretically on any time frame. But I will teach you from the perspective of the daily and the weekly, because they're what I trade, and they are the stronger moves. You could be in the trade for a lot longer and just simply manage the trade. It's a very beautiful thing when you've simply just got the trade working for you in the background, and all you have to do is really trial your stop loss, and that's it. That's what they call money working very hard for you. Okay, so this is quite a simple strategy. It's objective, and you can apply it to any asset class. Okay, it's risk managed, and I'll teach you everything you need to know to trade it. All right, so you've got that to take away with you. Okay, so we'll discuss the timing selection and the management, and we'll apply it to some practical examples, and I'll talk to you about also some opportunities coming up in the market as well after that. Okay, so as I've just mentioned, I mean, this strategy really does exemplify the benefits of set and forget lifestyle trading. You can take advantage of the big moves, requires minimal management, and you can just go about and do your thing, and it's really quite low maintenance in this respect. Taking advantage of the higher order time frames means that you're essentially taking advantage of much better established market structure. For example, if you're trading the daily and the weekly, and you've got a level of support and resistance, that's going to be a lot stronger than if you're trading on the hourly or the 15-minute time frame. Okay, they're the levels which banks, institutions, and a lot more prominent people in the market take advantage of. Okay, the cons are of this strategy. Okay, I don't know how your patience thresholds are, but setups don't happen very often. Okay, that's the biggest test for a lot of people new to the markets. They simply just can't stay out of the market. They want to be in the opportunity. Half the skill in trading is knowing when to trade and knowing when not to trade, and this is crucial of this strategy. We get 4 to 5 good setups a year, but if they're making money, then you won't be arguing, and you'll just be risk managing and trading your stop loss. Okay, so this is levels of supply and demand, also known as levels of support and resistance. So a level of supply is essentially a sell level, a level of resistance. It's like a ceiling preventing price from getting in the way. For example, the FTSE has just broken a huge level of supply. Conversely, a level of demand is a level of support or a buy level. It's like a floor preventing price from passing through it. For example, a big floor was Euro Swiss, that the level which was defended by the Swiss National Bank until they decided that they wouldn't defend the level anymore, and that floor broke. But essentially what we're going to be doing is learning how to trade off these strong levels, okay, in a supply and demand fashion, and of course being objective in the way we manage our trade. Okay, so there are different kinds of levels of support and resistance. There are hard levels and there are soft levels. A hard level is the level which we want to be taking advantage of. These are the levels which have held for over 10 months to a year and have only had 2 isolated tests. Okay, this is important. And again, this is on the daily and the weekly time frame. For example, pound New Zealand, that's in a very tight range. As logic would dictate, if you're trading a range, it would make sense to sell the top and to buy the bottom, would it not? Okay, I think a few people are nodding here. So yeah, I mean, it's pure logic, and this is what we're going on here as traders. We're simply going on the fact that if a range is established, it's a lot more likely to hold, and price is a lot more likely to revert back to the middle of the range than it is to break. If any level breaks, then we change tact, we get out of the trade. That's fine, we know to do that. We'll discuss that a little bit later on. Okay, so this is really an example of what I'm banging on about here. Okay, this is just a very simple one. And a hard level is level of resistance, 2 tests. The third test is our opportunity. We want at least 2 previous tests on this level of supply, level of resistance here, to qualify a potential sell opportunity here. And this is what we do. We just simply sell the top of the range and buy the bottom. At the bottom, we have what we call a level of demand, which is a buy zone. We can reasonably expect that people in the market will see value to buy here because this level hasn't been broken in X amount of time. I don't know if any of you are familiar with the Aussie-New Zealand chart, but this currency pair has been, well, it's just broken out now, but it's been range-bound for the past 25 years. So it's been very lucrative for traders trading in this style. So if price, as and when and if price comes down to this level of demand here, people will come into the market and typically buy unless the level breaks. And this is what we're riding on. We're riding on the higher probability of traders coming down, or when price comes down, traders buying at this point here rather than the level breaking. Of course, anything can happen, but we're just going on probabilities here. Okay? So, like I just mentioned, to have a buy setup, we want a floor, also known as a level of supply, which has been tested twice over the course of 10 months to a year, preferably. Okay, and we're just speculating that as and when price comes down that level again, that there's going to be a bounce, and we want to take advantage of that bounce. In trading or in the markets, there's an expression: you're either trading the bounce, the break, or the chase, BBC. If you're not trading the bounce or the break, you're chasing the trade, and we don't want to do that. But this is a bounce strategy, and it's got good probability behind it. Essentially, the higher the time frame, the more stable the chart is. Okay, so on the flip side, a sell setup is where we've got a level of resistance, like you've just seen, with 2 previous tests formed over the course of 10 months. And we're looking to sell at that level. As we'll demonstrate later, the FTSE has been a prime example of that, and so has well, Euro Swiss last year. But anyway, we've got 2 previous tests on this example here, followed by sell opportunity, and sell opportunity. Typically, these hard levels of support and resistance happen at big round numbers. These are typically the numbers where banks and institutions have their orders and where participants in the market are observing, and where we can typically see big reactions in the market. This is why these horizontal levels are formed at these levels. Okay? It's almost like a self-fulfilling prophecy, if you see what I mean. And this level of support here, also known as a buy zone or a level of demand, we've got the buy opportunity potentially here. We've seen 2 previous tests, and now we've got our potential opportunity to buy the bounce. Okay, so like I just mentioned, levels occur, round numbers, levels defended by central banks, or multi-year highs and lows. Could be a 20-year high, 5-year high or low. It just depends really, but these are all psychological numbers typically. Okay, so we've got an example here. We can cherry pick these opportunities. So for example, we've got 2 tests here on this level of, well, this sell level here, level of resistance, and we've got an opportunity forthcoming for this one here, approaching a level of demand. So you get the gist of it really, don't you? I mean, it's quite straightforward, but trading does not have to be difficult at all. There's an old expression, it's a cliche, but it's true. And I got taught this by my mentor back in the day. Trading is quite simple, but it's made complicated by idiots. And it's very easy to make it complicated. I made it massively complicated back in the day because I was struggling to, yes?
I've been looking at this on much shorter time frame.
Yes.
The difficulty is identifying the levels. There is never a nice sine wave, or very occasionally there is a nice sine wave which you can trade. But why not choose the? They're not always obvious, the levels, or are they?
No, sure. I mean, if there's any ambiguity, then I would say just don't trade it. On the smaller time frames, you're going to get a lot more noise in the market, intraday spikes, inexplicable movements. The shorter time frames for me are a nightmare to trade. There's no real rhyme or rhythm to them. They're a lot more susceptible to news. This is why the weekly and the daily time frames are a lot more stable. You can see this a lot more with much more clarity is the word I'm looking for.
You could have chosen the 2 after the first orange circle. There are another 2 peaks, not exactly the same level.
Mm-hmm.
Those would have worked just as well, wouldn't they?
These ones here.
Yeah, that one and the next one along.
We want 2 previous rejections though at the same level.
And At the same level?
At very much the same level, yes. That's the difference, yes.
Looking at this 10-month time, would you buy and sell and set your stop loss on the same time frame?
Yeah, sure. Stop loss, we'll manage the stop loss and place our orders on exactly the same time frame. This is a golden rule which we abide to, or abide by. So you can generally see the dynamics behind it, but we'll talk about trailing this in just a second. We'll just move on. So for example, this is the US dollar versus the Polish zloty. I know it's a bit of an obscure currency pair, but just because it's paired against the Polish zloty, it doesn't mean that it's an instrument. It's a pattern on the chart which fulfills our rules for entry. It doesn't really matter what the asset or the currency pair is. Okay, so we've got a strong level here. We've got a good floor. We've got test 1, test 2. There's our opportunity to potentially buy, because we can see that it's far more likely that price is potentially going to at least ricochet off it and go up than it is to break. That's the crucial difference. So it's true. Yeah. Sure, we'll get onto that very soon. Don't worry.
And the ricochet, the other difficulty on a shorter time frame I have, do I wait for 3 5-minute candles or 3 one-day candles going in the direction I want?
I'll talk to you about that in just...
Trade. That's the difficulty I've had.
Okay, so price action based confirmation.
Yeah.
We can if you want to, but this is just literally getting in. The price action based confirmation could very well happen, but you're in at the very beginning of the trade before that.
You don't look for 3 candles or 25% move.
Only if I'm building a position. So an aggressive trader would simply put a buy order on the level.
On that level.
Exactly, have their stop loss 50 to 100 or 150 pips below. But a more cautious trader might want to wait for a price action based reversal, like a bullish pin bar reversal. That's the thing, or a bullish hammer. You know, they're called so many things.
Or just follow the rules.
Yeah, exactly. I mean, there are modules on this on the website which last for were quite in depth and quite comprehensive. But for the purpose of this this seminar, we're going to keep things quite basic. But still effective. Simple does not mean ineffective, by the way. So here, just another example. We've got 2 tests, and this is the difference. When we're drawing these levels, key levels of supply and demand, the best ones are the ones where we have whiplash rejections. You can see here, the market just come up on the first and second instance and just shot back off it, like so. We don't really want those examples where price is just dithering around, where it could break out, it might not. We just want those examples where prices quickly ricocheted off it before. They're the better ones. So we've got a potential opportunity to sell here. Okay, so daily and the weekly time frames, they've got much better structure to them. More people pay attention to them, and you could be in trades for much longer as a result of getting in at the right place at the right time. Okay, so we place our orders with our broker here. That's the difference. We don't want to get an intraday. We literally put our orders on the level and walk away with our stop loss in place. And if you want to set your target, like you mentioned earlier, we put a limit order in. But as I'll discuss in just a second, there is a style of managing this trade where you can objectively just book your profit or bank your profit along the way, so you can essentially take advantage of a seismic move up without being getting out of a profitable trade prematurely. Because sometimes if you've exited a winning trade too early, you'll kick yourself if it goes on to the stars and back. That's the thing, and some of you might have experienced that. It is very frustrating where, you know, you've been proven right by the market, fantastic, you've booked a profit, great, but it goes a lot further in your direction. That's the definition of frustration. Okay, so here we go. And we'll apply this to actual examples. I just want to really make this kind of straightforward in this kind of illustration here. So we've got our entry on the level or just above it just to make sure we got filled. Got our stop loss 100 to 150 pips away. Our target, if you want a higher probability outcome but are happy with a smaller reward, then if you're trading a range, target the midpoints. If you're happier with a lower probability outcome but a higher profit potential, target 2. If you want the best of both worlds, like we all do, face it, we all want to make money here, what you can do is when you reach target 1, or if price goes in your favor and reaches target 1, then take half of your position off and leave the remainder to run. It's called scaling out. And that's the difference between taking all your money off when you're in a winning trade, which could make more money. You've taken half your profit off and you've got the remaining position running still. So that if it does break out to the upside, then you're still enjoying time in this trade, which has proven you right in the market. Okay? So it's always a good idea to give your entries and your stop loss, give it a wide berth, because sometimes you do get these spikes, which are essentially false breakouts, which occur at this level of supply. Quite often you'll see bearish pin bar reversals at the top of a range, or doji bars as the market's getting exhausted and people are starting to unwind their long position into the level. Okay, so vice versa. If you're selling this short, you want a high probability outcome but are happy with a smaller reward, target 1, the midpoint of this range would be the ace up your sleeve. If you're happy with a lower probability outcome but a higher reward, target 2. But as I said before, if you want the best of both worlds, target 1, you would take off half your position, bank half your profits, but leave the remainder of the trade to run just in case it does break this level of support and you're still in the move. Okay? So the first objective for us as traders, believe it or not, is to preserve our capital. Okay, that's absolutely essential. A lot of people don't think about that too much. So when this becomes invalid is where we've got to close below the level and the next bar takes out the low. That's the point of it being invalid. If you're going to close above the level and the next bar takes out the high, this is where the setup's invalid, and it means that you can essentially get out of the trade without taking a full loss. Okay, that's important. Sometimes the market doesn't do what we want it to do. That's fine. We can just manage it accordingly. Okay, so we'll go on to the management here. I'm going to show you in visual forms. It's much easier to digest than simply just reading this. Okay, so what we do is we have what we call a ratchet stop. So if we're in on this trade, how are we doing for time?
A couple of minutes if we can.
Yep, sure, a couple of minutes. So what we do is we trail it. If you've got 100 pips difference between your entry and your stop loss, trail it every 100 pips profit you have. So if you make 100 pips, you move your stop loss to break even. If you make 200 pips profit, you bank 100 pips. Okay? So this is an objective way of essentially managing this. Okay, and I know we're running out of time, so what I can do is I can essentially provide these slides for you. Okay, so drop me an email, and I'll give you my email address in just a second. So just if you're going short and you have, say, 100 pips stop loss, if you've made 100 pips profits, you move your stop loss to break even. If you've made 200 pips profit, you bank 100 pips profit. Okay, and it's a very objective management style which has worked without emotion, and you just do it in a very mechanical way. Okay, and lastly, and I know I kind of blitzed through the remainder of this, that's why I'm making these slides available. What I want to do is, just for today only, I want to invite you on board the Ultimate program which I'm running on the website, thelazytrader.com, which will teach you the set and forget strategies and how you can essentially become a lifestyle trader from as little as 10 minutes a day, valued at 1,997, online price 250, but today you can get access to it for only $100.80. So it's a 60% discount. If you go to the website, thelazytrader.com/forex training, promo code London Forex Show, and you'll get access to the strategies, weekly market analysis, trade ideas, trader hypnosis, which is something we've just launched, and we're launching a forum soon, so we're building up a community online as well. Okay, so if you're interested, thelazytrader.com, check out the ultimate package, get 60% off today only. This offer ends midnight tonight. Okay.
You don't get the rather cool black credit card though, do you? I think you should add that on, because I like that.
Yeah, a lot of people will ask about this credit card. It's almost like they sign up for the credit card only. But I'll say thank you very much, Simon, for letting me speak, and hopefully see you on board the program. If not, no love lost. But
dollars or pound sterling?
Afraid as it's an online product, I had to go with dollars, US dollars. So I guess it's about £80 to access it, roughly. Don't quote me on the exact number. I'm no mathematician.
Email address, you said?
Oh, it's rob@thelazytrader.com.
Great. Well,
The lazy trader.
The lazy trader, yeah.
Roll back the
That's right. Do I use Fibonacci? Yeah, as a confirmation, indeed, but I don't really... Oh, sorry, I don't use Fibonacci for what I've just shown you, that strategy, but trend-based strategies, yes, I use Fibonacci as a confirmation. Okay.
What about spreads? Because in that exotic human like Zloty, there's about a 40-point spread. Do you add that to the 100-point stop?
You can do, absolutely.
Do you do that? I mean, is that...
I do, yes. If you look at the chart, 40 points isn't that much. If you look at it, it's all relative.
Yeah,
Okay. All right. Any more questions? I know we're running out of time, but I've got to see next speaker is coming on. So, yeah, I'll be around. So if you've got any questions, just get in touch. Okay. Thank you, and enjoy the rest of your day.
Rob. Thank you very much. We're just going to rattle along just another few minutes, and then we'll be inviting our next speaker, Kevin Ashby, is going to start. So just a few minutes while we change over the slides.
Oh, no worries, no worries.
That was very good.
Thank you.
Yeah. Yes, I can go forward and back through those. Is that okay? Just one at a time? Yeah, sure. Or I might tell you which one to go to. Okay, that's fine. Excellent. Right. Well, we are live. Welcome everybody at home. Welcome back. Just about to continue on busy schedule today at the London Forex Show. Kevin Ashby, chairman of Studium. Is that correct? Kevin, you're correct me. Studium. Just going to carry on just now. The floor is yours, Kevin.
Okay, good afternoon. Just to give you a little bit of background in terms of myself. I spent most of my life in the technology industry, running a few technology businesses which built trading systems. I then became the founding chief executive of Saxo Bank Asia Pacific and built that business. And more recently, I was chief executive of London Capital Group, which is probably better known as Capital Spreads. Now sort of out of the industry and doing some completely different things. So you've got your sidebar up on here to get off. I'm now chairman of a company called Studium, and we basically develop sort of interactive websites and various other points. Just next slide, please. And one of the companies that we actually operate and own is a company called, it's basically a website called Traders DNA, which is basically publishes information for traders. It is a forum for traders to discuss things, etc. But that's not what I'm here to talk about. So I put together an agenda, and there's quite a few topics that when you're talking about, the industry from inside the industry that we could cover. So if I can actually have the next slide, please. So I put up a number of candidate topics talking about, and what I wanted to get from you guys, in case we run out of time, is if you look at those if you look at those topics in terms of the history of the industry, how the companies work in terms of business models, the regulatory environment, how they do pricing, the slippage, etc. Is there any particular topic that people would like me to start with, or should I just go through it in order? Because if there's something that someone really wants to sort of need to talk about, happy to do it that way, or just go in order. Okay, we'll just go in order then. So history of the market. I mean, pre-2005, I mean, basically the market was dominated by the major global players, like the Saxos and the FXCMs, because in those days, building a trading system was a very expensive business. And yes, there were some niche players, quite often country-based, who just operated in Hong Kong or just operated in the UK, but that's the way the market operated. They extended their businesses very much by entering into what's called white label partnerships, whereby other parties could actually start using their systems. And these white label partnerships worked on a very simple basis, where the provider offered the system, the processes, the execution, etc., and the white label partner primarily dealt with local marketing, etc. But there were really two types of partnership. Most of the international partnerships worked with regulated entities who were able to take client money, were able to do the onboarding of the clients, etc., etc. And the ultimate provider didn't actually touch. And so there's some big names out there who operate on the white label partnership basis. So anybody who remembers DBFX, that was actually run by FXCM. CityFX Pro is actually run by Saxo. So there's some big models out there that operate under that model. In the UK, we tend to have a slightly different model, whereby a lot of the white label partnerships in the UK are actually operating under the license of the holding company. So I won't use any particular names, but quite a few of my white label partners when I was at LCG, you think you're trading with Company X, but when you read into the small print, it says Company X is a trademark of London Capital Group. So, quite often these white label partnerships are quite structured in that way. But then again in 2005, MetaQuotes launched MT4, and that fundamentally changed the industry, because now you could get into the marketplace relatively quickly and efficiently and effectively. You didn't have to go to Saxo and ask for a white label. For 100 grand, you could have your own MT4 trading platform. And that literally spawned thousands and thousands, well, not thousands, I mean, I think it's over 1,000 now, MT4 brokers around the world, because it was quick and easy to get into the business. And the whole MT4 model was actually built around a thing called a B-book, a risk-based model, and I'll talk a little bit about that, but it's basically an aggregated risk model. MT4 has now been incredibly successful. If you go to certain parts of the world, if you wanted to open a brokerage, you have to have MT4, especially around Asia, Eastern Europe, etc. It's a really dominant platform. And of course, if you're a Saxo Bank or an FXCM, etc., and you've spent lots and lots of money building your own platform, they emotionally find it very difficult to then sort of support MT4 as well. But it's a growing thing, and people are moving on it. So in terms of what does that mean? So if you look at the way that leverage products work, then basically the original premise of this marketplace, and sad fact, is that most clients ultimately lose money. I mean, it's great that people like yourselves are coming here and learning about how to trade, because ultimately, if you look at this industry, it is based on the majority losing money. And of course, the more leverage people use, and when people start doing 500x 100 times leverage, it accelerates the outcome. And there's also a principle in this industry which is called the sparrows and the elephants, and it basically is, eat like sparrows and poo like elephants. And basically that means that a lot of traders, quite often when they're in a winning position and they've made $100, they'll take the profit straight away. And then if they're in a losing position, they'll say, oh, it will recover. I've only got to put I'm going to put a bit more margin in, it will recover. And that's sort of the psychology that people need to get away from, because that tends to move to a losing position. So if you look at sort of most of the FX businesses, if you look at the KPIs, what drives those businesses, it's your cost of acquisition. How much does it cost to get a new client? How much do you have to spend in advertising, on search words, etc.? And if you look now, £1,000 is not an unreasonable amount to pay in a developed marketplace such as the UK that you would spend. So if you think about, therefore, how much people have to make to recover that is quite significant. So it's very interesting. So these numbers are, how much it costs to get me a client, what's the long-term value of the client to me, what's the average lifetime of the client. And of course then you're reliant on a bedrock of clients who've been with you for some time who often make significant, but a lot of the business is built on bringing those clients in and making it move. Now, if you then look at the other factors that drive, of course, is this B-book model, which I'll talk a little bit about, but that's really sort of the aggregation of everybody's risk. And of course, how much risk you can take on as a broker is actually governed by how much capital you have and your appetite for risk. And of course that sits within regulatory frameworks. And in the UK we actually have a very good regulatory framework called an ICAP. And if you ever work for a broker in the UK, it's an incredible torturous process, because if you're looking at how much capital you need to run a broker, you not only have to look at how much capital do I need to cover my risk positions, you then have to say how much capital do I need to cover certain events. If my system goes down for a day, how many clients will I lose? How much capital do I need in the business to cover against that? If my company goes into insolvency, how much capital do I need to continue to pay the staff to run all that down carefully? So you have to look at all the risks in the business that define how much capital you need to operate a broker in a regulated environment.
Kevin, can I interrupt? The inevitable question based on the events last year, the last month with the Swiss franc and Al Pari, how would that situation arise where the processes weren't in place for the broker to cover for an eventuality like that happening? How did that?
I'll talk about that if we get to that slide, but let me answer that question. I think that the reality is when you put your ICAP in place, prior to the black swan event that is referred to as the Swiss franc, over the past 10, 15 years, when the market shut New York and then opened New Zealand, the market has never gapped by more than about 1%. So all of your risk assessments are based on what you think are reasonable events. And I think it's very difficult for someone to, within their ICAP, start saying, well, let's face it, a Swiss type event could take place. Because if you look at FXCM, that would have meant they would have needed an extra 250 million of capital to run their business. And that you can't use that stuff. It's got to be sitting there on a clean balance sheet. You can't use it to support your business. So all I'm saying is that the ICAPs, including, frankly, when I was running LCG, the ICAP would not have taken account of an event because it was so extreme. But, frankly, the guy who ran long-term credit, for any of you who are long enough to remember it, said they did a whole load of modelling, and the event that took LTC down was once in a million years, and then it happened again the following Tuesday.
Thank you.
So, next slide, please. Right, okay, sorry, you've moved on to the next slide, I haven't. So if you look at the way that most people moved, so you started off with this whole thing called a B-book. And basically a B-book is very simple. It's a bloody great bucket. So all of your people that are long Swiss, all your people short Swiss are in the same bucket, and basically you're then looking at your net exposure. So how much you're exposed in aggregate. And the B-book model, when the industry started off, I mean, I remember, when I first ran, Saxo, you were talking about 2-3 pips on the Eurodollar. So the whole model's changed, of course, when you've got, margin compression and spread compression. And so as the market moved forward, a lot of people became much more sophisticated and started creating a hybrid model, or what's often called an A-book model, which is where basically an A-book model is where you take a trade and you hedge it with a counterparty, rather than a B-book model, which is where you run the risk yourself. And so it's either when you're hedging an individual trade or when you're hedging an aggregate. And so, for example, when you would put something into an A-book can quite often be when you see a client that's using toxic flow. When you're sitting there with someone hitting your API with a high volume trading model and you say, I really don't want to see this business, and you therefore push it to a third party. Or a lot of companies have algorithms where they'll look at your trading style and they'll say, hey, this guy's trading style is pretty good, so we'll hedge all of his trades. We don't want to put them into the book because it will distort the book. Or when it's a large trade, so you say, well, I'll take anything into my own book when it's up to $500,000, but anything over $1 million I'll hedge. Or if it's a position in relation to your overall position risk requirement, where you say, hold on, the amount of exposure I've got in the Swiss franc is disproportionate to the whole book, so I want to hedge to bring that down proportionately. Or, for example, it's an instrument with very low levels of liquidity, and therefore there aren't enough people trading it in order to give you a proper book to hedge, so therefore you put it out the side. Or, as I said before, when your trading capacity, so one of the companies I ran, we had a PRR of 8 million. So if my net exposure started getting close to 8 million, I would hedge in the market to bring the net exposure down to within those limits. So. Next one, please. Regulatory environment. Regulatory environments are incredibly important because obviously the regulator that you're operating under defines a lot of the ways the company operates, the way the company segregates its funds, the way it does KYC, the way it does know your client, how you onboard, how you actually look at suitability rules about whether this product is suitable for your client, the risk and the business conduct. But of course, the FCA, if you think about it in the UK context, is having to look at and to govern everything from your smallest pawnbroker and individual IFAs right through to the size of Barclays Bank. And there are thousands and thousands of organisations they have to monitor. And if you look on the FCA website, you will see how many individual sort of ceasure notices they actually issue. But so they're very reliant on the FCA in terms of saying, right, we're very reliant upon the compliance officer within the business to maintain the rules and on the governance and structures within the companies. They've got to be reliant on that. I mean, the average spread betting company in the UK will probably get an FCA visit once every 4 years. The rest of the time, they're reliant on the compliance functions and reliant on the reporting of the organisation. They have to do that. There's no other way. Otherwise, you'd need an FCA, 20, 30 times the size. And of course, the level of regulatory oversight is also linked to the categorisation of the company. So, if you're a Barclays Bank where your failure can create systemic risk to the economy of the UK, you're in a completely different category to if you are a spread better, where if you go under, yes, there might be a few million loss, but it is not going to create a run on the UK economy. So they also focus their efforts depending on your exposure. And frankly, not all regulators are equal. I mean, the FCA is generally around the world, seen as pretty much a role model. But a lot of other regulators, you can do things within those economies, and you can do things with a company registered at a particular location. I'm not going to particularly want whether it's the Cayman Islands or wherever, where you can actually do things that you wouldn't be able to do in an FCA environment. And of course, one of the problems that running a company in the UK you face is that under the MiFID rules, a company that is established anywhere in the EU can operate and market into the UK marketplace, but not necessarily have to do so under the FCA rules. So MiFID is a bit like sort of you're only as strong as your sort of weakest boundary. Let me step out here, and it was something to wake up my PC to remember what I've said. So when you're opening an account, really look at the small print, because a lot of the global players, whether it's FXCM or Saxo or whatever, will have local domicile businesses. So you have to really say, well, making sure, am I actually trading with, for sake of argument, Kevin Ashby London Limited, or am I trading with Kevin Ashby Cyprus Limited or Cayman Islands Limited? So you really have to look at that small print to make sure you know under which jurisdiction and which legislation you're operating. And that was extremely important over the last few years, where until recently, binaries were not regulated in the UK, but you could offer binary platforms out of Cyprus. If you now look at social trading, where the FCA have been very, very prescriptive on the rules around social trading, so a lot of the social trading companies at the moment, their propositions aren't operating under the UK because the rules are so complex. Pricing and slippage. Agency, sort of as it's implied, means that really you're taking the wholesale price and widening it for the retail client. And of course, if you then look at how you do pricing as a retail broker, there's roughly one or two sort of models used. So one is where you take a single source of a data feed from a reliable vendor such as a Reuters or a major bank, and you use that to actually price your clients in terms of your retail price feed. Or what a lot of major players do is they use an aggregated price feed where they'll take price feeds from, let's say, 10 different banks, and they will actually aggregate them, and they'll look at taking the best bid and the best offer. Because what happens is if I'm a Deutsche Bank and my spread's that wide, but I've then, for example, got, let's say for sake of argument, Microsoft selling $1 billion against the euro, then I'll skew my prices so that I get that risk taken away so that people start hitting me. So quite often you can actually get inverse prices. You can get a bid and an offer which are actually inverse. So because of the way that the spreads work, etc. And FX pricing is actually counterintuitive. Most people don't realize this, but the bigger the trade size, the wider the spread. Because if I'm Deutsche Bank and someone's trading me for 5 million, I can probably spread that into the market very easily. Someone starts giving me $1 billion clip, I actually need time to get rid of that. So even the really big Deutsche Banks, I mean, they're not sitting there carrying trillions of dollars in their books. They're actually spreading that risk over the whole time. So when you start looking at some of the platforms that have depth of market, and I know FXCM one has, you start looking at, so the spread at 1 million clip will be different to at 5 million or 6 million or 7. And equally, if you start looking at exotic instruments where there's very little liquidity, the spreads will get wide even over like 500,000. And if you're in illiquid time, such as in the Asian time zone when the London market and the New York market's cut, then even the spreads will change during that time. And of course, what happened, some of these prices, I've said currency pairs from one bank, we're talking about 5,000 to 10,000 price updates a second. These are serious volumes going through. So you can understand, therefore, that if I send out a price from, let's say for where I was working, LCG, by the time it's got across the internet and got to you and you accepted it, the market could have moved. And that's where slippage comes from, where the market has moved between the price at the time you issued a price and the time you accepted it. And what obviously a lot of organisations do is to say, well, if the price has moved, but it's still within the spread, I'll take that. But if it hasn't, it's moved too much, then frankly, I'll push it back and either deal at a different price or reject the trade. And in fast-moving market, then gapping, which is what we saw with the Swiss situation, is sort of the main culprit of slippage. CFDs and spread betting, this is actually very simple. They're actually the same. Spread betting is just a wrapper over the top that makes it tax-free. It's still the same underlying instrument. From a personal point of view, I actually like the spread betting sort of metaphor because if you think about it in simple terms, if I'm buying, instead of buying 100 BP shares, I'm just betting £1 a point. It's the same underlying transaction. But I don't have to think about, if I'm buying $1 million, what is the price of a tick? Because the tick price and the value of a tick is different depending on the currency pair you're looking at, especially when you're looking at your home currency and you're trading in yen. And anybody who's doing stock trading, it's really interesting if you start looking at a graph in your currency versus the graph in the home currency, because the yield curves are completely different if you're trading yen and you're UK domiciled and you're looking at a yen stock in a yen graph. And retail FX is a CFD model. I mean, which is better for the consumer than spot because that means it's actually covered by the ombudsman. But in the industry, it's quite strange because CFD tends to be, instead of it being used in its full term, which is contract for difference, which is a trading style, it tends to be used to describe trading in individual equities. Whereas actually, it's a term of a contract. It's a contractual term. At least I'm not seeing anybody shaking their heads, which means that no one necessarily violently agreeing with me. Now, when it all goes wrong, is my money safe? Now, I am not giving any inside information, or I'm not working on the basis of anything that I know about Alpari or FXCM or anything that's gone wrong. I'm just telling you what the situation is from a legal and a structure point of view. Segregated funds are exactly what it says on the tin. They are segregated from the company's cash. And therefore, in theory, they are safe. But they're treated in aggregate. And this is the problem. If you look at sort of KPMG's sort of statements, it says, and they've done quite a few of these, then if you've got a situation where I've got £100,000 in the account and I wasn't trading, but there's lots of other people who now owe 50 grand each, 100 grand each, etc., because it happens very, very quickly, the amount of money in the segregated account in aggregate may not be enough to pay out all of the positive balances. Because in aggregate, they look at the segregated account in aggregate. And in theory, and we talked through your question before, the company's capital should be sufficient to cover the gap. Should be sufficient to cover the gap. But of course, if you have something like a black swan event, then the problem you get into is the company has lost a huge amount of money very quickly, and doesn't have sufficient capital left within its ICAP to carry on trading, because it doesn't have enough capital to wind down the company successfully, etc., 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 which is what leads to insolvency. And in the FSCS, which is the compensation scheme, you are covered up to 50,000. Now, if the bank that was holding the money went bankrupt, you're covered up to 85. But your deposits with a regulated broker are covered to 50,000. So if you had £60,000 in the account at the time a broker goes bankrupt and there isn't sufficient segregated funds around, you're reliant upon the insolvency practitioner to get enough money back from the company to make that gap between the 50 grand that you'll get covered by the insurance and the 10 grand extra you had in the account. And that's going to take quite a long time for liquidators to work out, because if you can imagine, you have to work out, when did this organisation go into default? At what time? Because if I'm a broker, I might have 10 million deposited with my counterparties. So therefore, depending on when the counterparties took that money, whose money was it? Was it still mine because I wasn't in default, or was it still the company's? There's a lot of issues. And one of the other issues you tend to get as well is that there's a whole lot of claims coming on missegregation. So, you know, if I was a professional trader and I had my money non-segregated, let's say I had 100 grand, and the company I'm trading with has now gone belly up, then I'm going to turn around and make a claim to the Ombudsman to say, well, actually my money should have been segregated, I was mistreated, I wasn't handled properly. So all of those claims have got to be worked out, all the real balances, what should have been segregated, etc. And that all assumes there's been no fraudulent activity, in that people didn't try, you know, sort of trading their way out of the situation. I mean, when I was in Asia, there was a very famous case where, you know, a client got into trouble, and then a broker got into trouble, and basically were trying to trade their way out of trouble with client funds, and basically the whole lot was wiped out. And that becomes, you know, a several-year process. Okay, so, well, we got all the way through it, with 5 minutes to go so far. So, talking about the future, I think social trading, if anybody's sort of not looked at that, this whole sort of follow me, copy me model, I think that's fantastic. I mean, there's a whole lot of regulatory issues around it, but if you look at the sort of the growth of people like eToro and some of the things that Ayondo are doing, etc., and some of those other products, it's fantastic, because, you know, what people are now doing is to say, well, let me identify 5 people to follow, and let's follow them sensibly. Let's put 10 quid behind each one and look at them, etc. And it becomes a social activity, because people start saying, well, I actually believe in this, and the reason I'm trading in this, it's actually quite an interesting model, and it's becoming to be, you know, quite a social activity, and I think it's great. But it's fraught with regulatory issues, because in the UK, what the FCA have said is that if I'm, let's say I've got an account with company XYZ and people are following me, then company XYZ has a legal obligation to manage me and to make sure that I'm not doing anything wrong. It means they sit underneath their regulation. It's actually called a managing funds regulation. And therefore, if in my blog, I say, hey, I'm a long-short equity trader, and then I do a whole big oil trade which loses a whole load of money, or some FX trades, then in theory, someone who's followed me and has copied me can go back up to the broker and say, you allowed him to trade outside his range, or you allowed him to volume trade, and etc. So there's a whole regulatory mess around this at the moment, which is why a lot of the social trading is happening offshore. Binary trading, if you haven't come across that, binary options, I think that's a great business model, because it basically just says, do you believe if the price is £1 now, in an hour's time, will it be higher or will it be lower? And, you know, if you bet 10 quid, I'll pay you back £8.50 if you're right. And it's a great model because it's very simple for people to understand, and it gets people back, it sort of gets retail people who've not really understood trading to start looking at the industry, and it has a bit more of that gambling feel about it. And quite a few people are actually using it as actually to, you know, when the markets aren't volatile, but I still fancy a little bit of flutter on the market and what's happening. So it's a very fascinating. Grown hugely in Asia, not really started much in the UK yet, but been very successful. And I said it's both binary trading and social trading are regulated in the UK, but they're not uniformly regulated outside the UK. So just be aware of that. On the platform front, I think there's a lot of new stuff coming, which I've seen and I've been involved in. I've seen a lot of people doing sentiment indicators, where they start saying our clients are 70% long or 50% long, But beware a bit of that, because I know one of the companies that's doing that, they will then say our data can be 10 minutes out of date. You do not want to know what people were thinking 10 minutes ago. What you actually want to see is the trend. You want to see that 10 minutes ago they were 50% long, now they're 80% long. You want to see the time over trade, and that type of product's coming into the marketplace. Pattern recognition, and I saw the guy doing charts, but there's some great products coming out now where they're saying the last time the euro did this, the next trade was X. And so it starts looking at pattern recognition where you say, the last 30 times the euro did that over 4 days, on the 5th day it did this or that or whatever. So those patterns are quite interesting. And the other thing that's coming out is social and news sentiment, and I was involved and still involved with quite a lot myself. And that's where people are actually looking at things like Twitter feeds and looking at things like Dow Jones and looking at the news and searching through that. And interestingly enough, the fear factor on the Swiss franc went like that about 20 minutes before the announcement was made. People start saying things whether they're intending to or not. And so one of the companies that I worked with, it was actually fascinating to see. So what they basically do is they search through all the Twitter feeds and start looking at people who are commenting on like the dollar or commenting on the Swiss, etc., and they aggregate all of that information, and then you can see the tweets that are supporting that, and it's incredibly insightful. I think some of those things are really important, because what's happening with regulation, as you guys know, years ago it was very easy to, as a broker on a phone, to say, look, I think you should do this or I think you should do that. Giving someone personal advice now without really understanding them and their risk appetite is very, very dangerous. So companies have to give very, very generic advice now. And that's why I think these tools are becoming quite important, because if you see that, if you're looking at the chart and it's telling you to go long dollar, and then you look at the sentiment and it's telling you that most people are moving long dollar, and then you look at the Twitter feeds and it say people are getting very positive about the dollar, you can, those multiple indicators help people make decisions where the company can't say, I think you should do X. I think the other thing that's going to happen over the next few years, and we've already seen it with the likes of IG and Saxo, etc., is the diversification trend. IG has now very much moved into sort of operating equities, etc., and that's just the industry maturing. Because if you look in the UK at the moment, based on this company whose name I've immediately forgotten, it's an age thing. They do a trend, they do a sort of forecast analysis, and it roughly says there's about 100,000 people who regularly spread bet in the UK, and about 20% of those move accounts each year, and about 20% stop trading, and about 20% come in. So that's a mature market, and those markets haven't, a lot of markets haven't matured around the world. There's a lot of growth in the Asian region as well at the moment, obviously very much in China, and then India's coming along as well. But obviously a lot of the organisations now that have got quite sizable are saying, I need to actually balance my business, and therefore, rather than just be dependent upon CFD trading and spread betting, I want to get into other marketplaces, which will give me a much more smoother business and a much more easier business to manage. So if I've not covered everything you want, and if we don't have time to answer your questions, then please grab hold of me, or send me an email, kevin.ashby@studium.com, or I'm on LinkedIn profile. And I think with all things, what I found is that when I was talking to people about some of these subjects, and I was checking my work on what happens if a company if a company fails, I talked to 4 different compliance officers, and all of them have slightly different opinions. So the great thing about these events is you can take any one of these subjects or something that concerns you and go and talk to as many people as possible, because it's not all set in concrete. A lot of the discussions I had with the FCA were about onboarding rules, and I was saying, well, why can that company do this and you're telling me I can't? There's a lot of interpretation around what you can and can't do, and a lot of soft interpretation. So thank you very much for being polite and listening to me. And
Kevin, thank you very much.
I'm not sure if we've got any time for questions.
Don't often get a chance to hear a very honest, transparent, this is how it works from the other side.
It's easy to be transparent when you're retired and no longer operating in the industry and spending your time in investing in fintech businesses.
No one can sack you anymore.
No one can fire me anymore. No shareholders.
Thank you very much. We get some terrific feedback from the webinar attendees as well. Very, very grateful for that. Well, we're just going to move right along in a couple of minutes with our next speaker, David Paul. If we can just take a break for about 3 or 4 minutes. We'll be back very shortly to commence with David Paul. Thank you. Well, way to go. You want to...
The handheld is on the left.
Oh, we're still using the handheld, sorry. So it's on the lecture. Okay, so we'll just get started straight away. Ladies and gentlemen, David Paul from Vectorvest UK.
Good afternoon, everyone. There's a few more coming in. It's great to see you all. I'm David Paul. And what I want to try and talk about this afternoon is to use a simple pattern which is counterintuitive that can take money out of all markets and pretty much all time frames. You can relax because I've got nothing to sell. All right, so you don't have to feel stressed. I've got absolutely nothing to sell. So I'll explain my background in a second, Simon, if you can go to the next slide, or first slide, should I say. I have to put up a disclaimer because I'm not allowed to give one-on-one financial advice, okay? Before I can give financial advice, I need to have done a fact find and all sorts of ghastly things. I don't know, John, whether you borrowed that suit, whether that suits your own, okay? So I don't know anything about your background, so I can't give one-on-one financial advice. And believe it or not, Simon, who's sitting there, is my compliance officer. So if I, in fact, get out of kilter, he's going to be coming across and give me a long lecture. So that said, that's made your day. So let's go to the next slide. So what I do is that I intraday trade the FTSE, the DAX, the Dow, and Forex. I don't do it every day, but most days. In the morning, and I'll show you the basis of how I go about doing that. Believe it or not, it's pretty much the same way as I would go about trading a daily chart of a UK share called Prudential, which I've got a slide of. The methodology is exactly the same, except in the stock market, one can add the fundamentals to the picture. Whereas, to the best of my knowledge, the euro-dollar or the DAX doesn't, in fact, print annual reports. Am I correct in that? Okay, so very difficult to do the fundamental position of the euro-dollar. Okay, so I have to trade that purely technically, and by trading it purely technically, my hit rate goes down a little bit. So my hit rate in stocks is higher than my hit rate in the Forex market because I can add the fundamental position and I can also add volume. In the Forex market, as you know, there are volume figures, but I don't trust them. Reuters themselves have taken volume off their data feed because they say they can't trust the providers. So maybe if you're trading Forex, the so-called 6E contract in Chicago, which is a futures contract, then you can rely on the volume numbers from the CMA, but I don't think you can rely on the volume numbers in spot Forex. Anybody got an opinion on that? I don't think you can. Okay. So I swing trade in indices, Forex and FTSE 350 companies, and I take long positions in long-term trades in the stock market, looking for a mixture of capital growth and dividend growth. That's my pension. And as we speak today, it's a nervous afternoon because I am 95% invested in the stock market, hoping and praying that the Greeks finally toe the line and the FTSE is going to break 77,000 for the first time in 15 years. But if, ladies and gentlemen, the damn FTSE broke the 7,000 level and I wasn't aboard, I would be incredibly upset because I've been watching the damn thing every single tick for the last 15 years. There's 4 trading fears. 1 is being wrong. 2 is losing money. 3 is missing out. And 4 is leaving money on the table. Everything you do in trading is a function of those 4 fears. Now, I'm looking at 2 gentlemen, 3 gentlemen now, 2 at the front here. If you're over 50, are you over 50? A tad?
Yeah, go on.
A tad over 50. If you're over 50 and male, then I think that you're probably less scared of death than you are of being wrong or losing money. Okay, so those are major fears. Am I correct? You get on in life, you say, well, death, we don't want to die, but, well, it's not the end of the world. We'll be fine. Okay, so major fears along the way. I am the managing director of VectorVest in South Africa and in the UK, and I use the VectorVest product for number 2 and number 3 because it adds the fundamentals to the picture. In slot number 1, there are no fundamentals. The fundamentals of the FTSE doesn't change much between 8 o'clock and 10 o'clock in the morning, which is primarily when I'm trying to actually take some money out of the FTSE in the morning. So I trade that purely technically. So that's what I do, and as I say, I'm busy building up a pension fund for myself. I'm 60. I may not look at girls, but I'm 60, okay? And it's a big day for me today because my daughter gave birth this morning, so I'm a granddad today. Can you believe that? 2 weeks early, I was hoping to be there, but it's quite amazing, actually, a granddad. Okay. So next slide, please, Simon. So the 3 pillars, and I'm sure all the rest of the speakers have been through this with you 1,000 times. Some form of methodology, managing your money really well, and managing yourself really well. And I see we have a lady upstairs who's a hypnotherapist, and I think that has merit. I think that has a lot of merit in terms of building beliefs. So I'm going to talk largely about 1. I've mentioned 2, and towards the end I'll mention 3 a little bit as well. So Simon, if you can go to the next slide, please. Okay, my 3 rules in trading any market. Okay, 1, the good trade is a hard trade, always. And when I say it's a hard trade, I don't mean it's intellectually tough. I mean that it's difficult to do. If the trade looks easy, ladies and gentlemen, and it looks as if it's going to blast up the page, then, sir, you are just about to be sexually violated. Okay? See, it's happened to this young man before here. Don't enjoy it, okay? So the good trade is the hard trade. You don't have to be bright. In fact, I'm pretty much sure that the thicker, the better at times. The good trade is the hard trade. Rule number 2 is that I fade the short-term trend in the direction of the long-term trend. So I define a longer-term trend in the market, and I wait in simple language for a pullback, and I'm going to show the exact mechanism of doing that. And I'm going to show you how I actually work out. And the rule is you've got to be able to count to 21. Who can count to 21 here? You? Okay. You're okay with that, sir? Okay. On your fingers, international language, okay. So if you can count to 21, you're good. And number 3 is critical. I place my entries where the masses place their stops. Okay, here's what I want you to do. This young man here with a black pullover. On your dining room table at home, okay, and just beside your trading desk, I want you on the way home tonight to pick up a brick from a building site, right? Okay, and I want you to put that brick on your trading desk on Monday morning. On Monday morning, you're just about to put on your first trade, yeah? Okay, and you work out your entry point, you work out your stop. Just before you press the button, I want you to pick up the brick and beat it around your head. Will you do that for me? Okay. And then, rather than putting the order on with a market order, you put in a buy limit or a sell limit, depending on the direction, at the stop loss. And you work out how many times the damn thing goes to the stop loss. Markets will move to the obvious stops over and over and over and over again. Okay, so just try that on Monday morning. Have you ever been stopped out in the Forex market? Very easy to die in a sea of stop losses. So those are my 3 rules that I look at every market, whether I'm trading a 5-minute chart of the FTSE or a daily chart of my example that I'm going to put up in a moment. Next! You've all heard of next on the high street? Okay? So, Simon, next chart. Now, in 1998, one of the best books on trading was written by 2 characters called Larry Connors and Linda Bradford Reschke, and I apologize if I've got her name wrong, okay? It's a difficult one. She's got a squeaky, squeaky, squeaky little voice. If you go to a seminar of hers after the 3rd hour, you're freaking out. And this little book had about 20 setups in it. It wasn't a book on technical analysis, a book on trading setups. Has anybody read it? Well, it's a cracking little book, isn't it? Okay, it was priced, it was quite expensive at the time. It was a couple of $100 when it came out. But I think that if you were to invest in street smarts, ladies and gentlemen, it's much cheaper now. And there was lots and lots of setups there, but the one set that I really liked was this setup called Turtle Soup. Now, the Turtles was a group of traders that were mentored by a character called Richard Dennis, who'd made himself a multi-millionaire. And Dennis took this group of youngsters. They were called the Turtles because Dennis was doing a lecture tour in Singapore, and in Singapore they breed turtles, and the New York Times said that they breed turtles in Singapore, and Dennis is breeding traders in Chicago, so they were called the Turtles. And these group of traders went on to make more money than any other group in history, they say. Okay, now their entry criteria, Richard Dennis, was a break of a 20-bar high. So when the market moves up through a 20-bar high, you would buy the market. When the market breaks down through the lowest point on the last 20 bars, you would sell the market. And it's a long-term trend-following technique, and it's been written about by a fellow called Michael Covell, and his book's at every bookshop, called Trend Following. Innovative name. Trend Following, that's what the book is called. Anybody read it? It's a good read. Now, what Linda Bradford Reschke and Connors suggested was in fact going against it. That's why it's called Turtle Soup, because the market would break the 20-bar high and then move back. Okay, that's why it's Turtle Soup. And the Turtle Soup plus one is in fact selling the break. If it breaks out north, you actually sell the breakout on the 21st bar. That's why it's called Turtle Soup plus one. Okay, so that is the basis of what I'm going to talk about today. So, and I'll show you exactly how I do it, and I can guarantee you one thing, that if you were to never, ever, ever use anything else in the rest of your trading life, you'll be profitable. How's that? Simon, am I allowed to say that?
Yes.
Just about. Okay.
More or less what Kevin was talking about before us. But
so let's go on now. On the next slide, I call him my mentor. I've never met the man, but when I started this in 1982, I was mesmerized by the work of William Delbert Gann. And Gann wrote material. Has anybody read or studied his work? Not an easy read, but great stuff. And Gann had a trading technique, and I've researched his trades for many years, and he had a trading technique which he called lost motion, which was in fact similar to the 20-bar break. And the basis of what I want to try and present to you this afternoon is Gann's lost motion technique. Now, I do a 3-day course in the Forex markets. Largely, I just do it these days for institutional traders. The last I did was for Standard Chartered. We did a full week training seminar in the Hilton Hotel in Sri Lanka for all of our foreign exchange traders in the whole of Southeast Asia. I do 3-day courses for Barclays and for Investec. And I've been doing that for a very, very long time. So what I've done this afternoon is I just want to pull the plum out of that and give you that. Okay. There's dozens and dozens of other patterns, but you only need one pattern to be successful. Just one thing that you do over and over and over and over again without fear or hesitation. And that's where the trading psychology comes in. Okay. I say I use this pattern on intraday, on indices and Forex, and my speciality in the Forex markets 4-hour charts. Normally when I look at something which is less than a 4-hour chart, it's trying to hone the entry point. I look at what a previous speaker talked about, the weekly charts and the monthly charts, but the problem with those is if you do get a breakout, it takes you about 500 points to keep you in the trade, which is just too costly for me. So what I want to try and do very quickly now is to show you how to engineer high reward to risk trades, where when you're right, you should be making 3 to 4 to 5 times more than when you're wrong. And I want to show you how to get that right about 60% of the time. If I can do that, let's say you can make 3 times more when you're right than you lose when you're wrong. You can get it right 60% of the time. 6 threes is 18 and 4 ones is 4. You've got a positive expectancy system, in the words of a trading shrink called Van Tharp. Van Tharp kicked me out of his course once. We had to do all our trading records, and I was using the FTSE in the morning to put my trades in place, and we had to do this report to him every day. And after 2 weeks, he says, David, going to the gym is not a valid reason for getting out of a trade. If the FTSE's going my way, and I'm up a tick or two, and it gets to about 11 o'clock, then the LA Fitness is calling. And I may not look like it, but I'm there every day. And although I'm 60, anybody that feels like having a go, we can have a go. Okay? That's as simple as that. Is that too violent, Simon? Okay. It's not easy presenting with your compliance officer on your right-hand side, and he thinks at times he's Mel Gibson out of Braveheart, you know. So let's go to the next chart. Next thing, and I've got a chart here. It's a chart of the FTSE. It's a 4-hour chart of the FTSE. Now, the FTSE, it's a chart, this is in January, it's a good example. The market comes down to here, and it makes a low. And then it moves down here, and it breaks that low. Ladies and gentlemen, I only buy at 21 bar lows. At least 21 bar lows. Okay? And I only sell the damn thing at least 21 bar highs. If you can do that, you'll find it'll turn your trading around. Okay, so I see this market taking out a low, and the bar that takes out the low is universally known as the poke bar on the floor of the Chicago Mercantile Exchange, where yours truly spent 6 months once upon a time. Okay, I've traded institutionally for lengths, but the last time I traded at a fund, I left one day. I was there 6 months. The exit interview, the chap says to me, well, why did you leave? You're on a really good wicket here. I'm making good money. And I said to the guy that when I leave this bank every night, I feel as if I've got out of prison. Okay, so it's not for me. I've been tied down. The market takes out the low. The market should take out a low, right? That would be, in fact, the turtles going short. And then it turns. Now, the simplest entry is to put your buy entry at the high of the poke bar and watch it go. So there's 2 simple requirements. One, the market must take out a major low for a buy. The poke bar should be at 21, at least a 21 bar low. And this is where you got to count. So you count, there's the poke bar, and you just count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So that point was in fact the lowest point for the last 26, 27 days, 26, 27 bars. So it fills both criteria. If that's the case, you're now looking to be a buyer. Now, the simplest entry is in fact just to buy that level. But when you see that happening, ladies and gentlemen, on the 4-hour chart, by all means, blow it up to a 30-minute chart and try and get a better entry. Now, what I've done is that on a 4-hour chart, I can risk 30 ticks to make 200 or 300, and I can do it all the time. by doing that. So the easy trade would have been to sell the breakout. The good trade is the hard trade. This thing is slamming down the page, right? And you're buying it. Now, Mr. Gann, if he was here, Mr. Gann would buy at the line, which was the old low. Now, sometimes I'm around and sometimes I can watch for a turning point down there, but sometimes I'm out and about, and then I'm quite happy to get in at the high of the poke bar. It just means my stop's a little bit bigger. I don't trade as big. What's the hurry? You can only drink one beer at once. It doesn't matter how hard you try. You only drink one at once. So here's so the bar that breaks the low is the poke bar. The poke bar should be a 21 bar low. Buy a break of the high of the poke bar and a stop at the low. Trade 3 lots. Exit a third when you're up about 30 ticks. Now, here's what you do in the second. You've now got 2/3 back, 2/3 left, right? Bring your stop to entry on one of them and bring your stop to minus 30 ticks on the other. That means that you've made 30 ticks in a third, but you've got one stop at entry, you can't lose any money on that, and you've got one stop at minus 30. So it means that if the trade goes bad, you can't lose any money. That's how I do it. I'm not saying it's right, but that's how I do it. Because frequently the market will come back and clip the stop. Okay, and if it does do that, at least you get one position running. Does that make sense to everybody? Okay, so you get in, and the closer to the low you can get in. So if you're around and you see the market breaking a low and you see it's a 21 bar low, then you can look at the 30-minute chart to try and get a tighter entry there if you've got the emotional response to do that. 30-minute charts have got an awful lot more noise in them, and as long as you can handle it, don't go any lower than 30 minutes. When you get down to 5-minute charts, well, it would drive you to drink down there, okay? There's a lot of noise, and you need to have a very strong emotional response to trade a 5-minute chart, okay? Everybody thinks they can. The brokers default to a 5-minute chart because they know that they can't, okay? So they just take their money. That's the basis. Now, there was another one right here. Market comes down, takes out the low. That red bar is the poke bar. Buy it at the high of the poke bar, stop loss down there, and it moves up the page. I think that on this, if you get a V in the market like this, Mr. Gann said, take a third off, work your stops as I've suggested, and then look to take the second one off at the old high, and let the third one run. So on this one, got 30 ticks there. Stop to entry, one stop to minus 30, and then let it run to that old high, and then it bombed out on us. Now, I was sitting watching the FTSE just there, and it didn't come back to that level. If it come back to that level, I think that would have been a 21 bar low. I only buy at 21 bar lows. Only. And I only sell at 21 bar highs. Now, I want to do it with the trend. If the trend is strongly up, I only want to be a buyer at 21 bar lows. If the trend is strongly down, I only want to be a seller at 21 bar highs. And if there's no trend at all, you can go both ways. Buy the 21 bar lows, sell the 21 bar highs. Okay, so you've got to use your loaf to work out whether there's a trend in the market or not. I can use an 89 period moving average to determine the trend. But folks, if you just expand the chart and have a look at it, you can see whether the damn thing's going down, whether the damn thing's going up, or whether the damn thing's going nowhere. So some people like a moving average on there because it gives them something to hold on to. Next chart, please, Simon. Okay, there's the Prudential. You all know the Prudential, the man from the Pru. Does he still exist? My uncle was one. He made a very good living out of it. Prudential is a company. It's a FTSE 100 financial services company, very strong in the East. My company, Vector Vest, says that it's significantly undervalued at the moment. and that its fundamentals, it's growing its earnings both aggressively and safely. So the fundamental position of the Prudential over the last year was great, and I want to buy it at a really good place. So, same damn thing. I'm waiting for it to take out that low. There's the poke bar. That was the trade. You can do this simple. It's easy. It's much easier to do on the stock market than on the forex market, because in the stock market you can work out which shares have got the best fundamentals and will be aggressively accumulated by professionals at lows. Okay? And then it does the same thing again. And I was waiting patiently just there, and in fact I had to chase it a little bit to get in here. But the Prudential, and now it's moving sideways in what's called a bear flag. I'd be waiting for it to take out some lows. It took out a low there, but that wasn't a 21 bar low. And remember, I only buy 21 bar lows. Okay? In the direction of the trend. But the trend in the Prudential is strongly up. If you look at a weekly chart, strongly up. Took out that low and flew. Took out that low and flew up the page. Those are the October lows. That's the August low. Okay? And goes, charts a nice little triangle here, breaks out of the triangle. I'll show you why in a minute. Flew up the page. Simon, the next one. In shares, I only trade shares that are undervalued, that are growing their earnings aggressively. And adding the fundamental position, which is automatically calculated in Vector Vest, and the lost motion technique for exit really pulls some cracking big reward to risk trades out of the stock market. Thank you. Next one. There's next. Next, in the throes of a big weekly trend, moved up strongly since I've done this, but in November comes back and takes out that low. Waiting for it, got in a bit late because the poke bar, that happened in one day, went right to the orders, broke up through there, and has been going very nicely since. So if you wanted to spread bet with exactly the same technique on shares, the technique worked beautifully. That's only one of the things in my toolbox, but it's the best. It's called Lost Motion, made famous by William Delbert Gann in his book, written in 1933. Okay, next one, Simon. Okay, the pound against the dollar. The pound against the dollar at this stage was in a strong downtrend. This is December, January, and it moves up here, comes up, takes out that top. Now, that top is a 21 bar high, and there's the low of the poke bar, and it falls out of bed. Okay, just keeps on going. Does the same here. See? Comes up, takes out that high. Trend is down. Now remember, if the trend was down, I want to sell 21 bar highs. The trend is up, I want to buy 21 bar lows. Trend is down, takes out that level, and we get a little doji candle as the poke bar. You sell the low of that doji, and it falls out of bed. Can it be this easy? Yeah. You got to wait for them. Okay? Unfortunately, most people are on the wrong side of that. As it breaks up, it takes the crowd with it. Mr. Gann said so beautifully, if it's obvious, it's obviously wrong. Okay? So, what I've done is that the good traders are hard to it. I assure you, selling it up there wasn't easy. Market's rising, you're selling it. I faded the short-term trend, which was up in the direction of the long-term trend, and I put my entries where the masses put their stop, because it went up there. The stops were all sitting up around there. There was enough stops up there to generate the liquidity for the institutional fellows to take the other side of the position. Remember, if you're trading the euro-dollar at £10 a point, you can press the wee button and you're in. But if you're sitting in Canary Wharf, you've got to generate the liquidity to get in. You just can't press the button. So largely, a whole football stadium full of small guys are running the wrong way for one institutional trade to go the right way. Markets don't like people getting rich that shouldn't be getting rich. They like to funnel the loot to those people who really deserve it. Do you really deserve it, gentlemen? Of course you do. Of course you do. Okay. Simon, let's go. All right, what's this? This is the cable. You know what cable is? The pound against the dollar? Okay. If you call it the pound against the dollar, forex traders will look upon you as a child of a lesser god. Okay. So it's like taking sweets from children, guys. The trend is down. It goes up, takes out the top. Doji falls through the page, and then we get one against the trend. Now, as we'll see in a minute, if I've got time for it, I don't mind going against the trend if I see the market making 3 drives to a bottom. Are you familiar with a technical concept of 3 drives to a bottom? It's called a wedge pattern. I've got another slide of it in a moment. That was that was one against the trend. Now, there's one, if you had traded this with the trend, you could easily have got that wrong. Okay. There was the poke bar, and you would have got that wrong. That's a bad one. Simple as that. There's bad ones all the time. And there was a nice little trade just down here. So, Simon, let's go. You want to do a bit of work at this. There's a trade that I put on this week. That's the dollar against the yen. I put on a 89 period average, and it comes down. It takes out that low. That low is definitely a 21 bar low. Breaks the high. Away it goes. Okay, and since I've done this, it's settled into a range here. All right, it's relatively simple. There was a trade you could have probably taken there, and there was a short that you could have taken there in this range. Simon, next one. That is the Aussie. It's a beauty. It comes up, takes out those highs, and then gives a nice doji candle, and you had a sweat a day or two before it went in your way. And just remember, folks, that many of them you will sweat out, I assure you. Okay? Next one, Simon. This is the Canadian. It's a good one. This is a 21 bar high, and it breaks. There was a high across there, and it breaks down, but this is one there's the high, takes that high out, there's the doji, and you sell it at the low of the poke bar, comes down the page, and that I think was yesterday morning. We were right down here. That was a 21 bar low, and yours truly bought it just there. And Simon, if you go to the next one. That's what happened, okay? And then it got up the page, right? Got up to page to there, and that bar was a 21 bar high, and it took out that high, and then the little bugger goes the other way again. So as soon as you get a 21 bar high, you've got to be ready to go the other way. You'll find that this 21 comes up over and over and over again because there's so many algos trading the 21 bar breakout. Quite different. Next one, Simon. Okay. No, that's fine. That's fine, Simon. This is a dollar against the Canadian. Got a major level in the market here. Comes right down, takes out that level. Now, folks, it's only going to take out the level by a tick. Even if it makes a double bottom, the spread will take out all the stops. Okay, so it takes it out, and then it reverses, and we got a nice inside bar, and it breaks up, and again you had to sweat before you got that one. The trend is up. I faded the short-term trend, which was down in the direction of the long-term trend, and I put my entries where the masses put their stops. Okay, next one, Simon. Now there's before the non-farm payrolls. That's the pound against the dollar. I think last Friday. Maybe Friday before, it came down, took out those levels, and then reverses up the page. That's not easy. That wasn't easy. Okay, that happened really, really, really quick. Those of you that have traded non-farm payrolls on a Friday will know you've got to be on your game. Okay, who trades non-farm payrolls? Certainly not me. Okay, that's for somebody else. Okay, I don't need that in my life. There's plenty of nice moves about killing yourself on the first Friday of every month. Okay. Next one, Simon. So now I'm running out of time here, but there are candle patterns which, if they occur as the poke bar, adds to the validity of the signal. So candle patterns such as a doji morning and evening stars, hammer and shooting stars, which I'm sure you've all studied. If the poke bar, for example, if it goes right down, takes out the low, it's a 21 bar low, and the poke bar is in fact a hammer, then that's virtually as sure as you can get in trading. You wanted to take out out the low, a 21 bar low, and the overall trend is up, and you get a hammer, and your quid's in. Okay, simple as that. The way it's going to go. So let's keep going here, Simon. Am I running out of time?
5 minutes.
What?
5 minutes.
I've spent a lifetime researching bar chart patterns, and I've got a few here. If we keep going there, Simon, I've got a few. Inside bars I love. If you get, that's the poke bar, and this is a 21 bar low, and then all of a sudden you get 3 or 4 bars inside that, and then it breaks through the high, away it'll go. So if the poke bar is followed by 3 or 4 inside bars, the more bars the better, and it breaks the high of the poke bar, away it goes. Okay, so if you see a poke bar, it could be a doji, that's great. If it breaks the high of the doji, great. But it could these inside bars are very, very common after the poke bar. Remember, got to be in the direction of the trend. If the trend is up, you only want to be getting aboard at least a 21 bar low. Anything less than that, it's iffy. Pardon? It's like a spring. You're winding up a spring. That's really what you're doing. Okay? Markets contracting, and then when it makes a decision, away it goes. All right? Inside bars, cracking things. They're not my own work, but if you research them on the net, I'm damned if I know why this hasn't come out properly. Next one, Simon. Clearly, that's the mirror image, so we can crack through these. And I have an example of inside bars, and then it breaks, and a bit of a sweat before it moves, but it moves. Outside bars are the same now. Outside bars are my favorite pattern, where one bar will engulf the range of 3 or 4 bars. So if you see an outside bar, which in fact reverses at a 21 bar low, that's virtually a certainty. Love outside bars. Okay. It's an exceptionally strong formation, and sometimes I trade nothing else. A reversal signal at a 21 bar high with lost motion does not get much better. So we can go through this, Simon. And the outside bar that I've got, in fact, is this one that came out of the triangle in Prudential. Look at this big outside bar. There's the high minus the low, and now we've got, it engulfs 1, 2, 3, 4, 5, maybe 6 bars, and it flies, just cracking things outside bars. So next one. 2 bar outside reversals, if we keep going, Simon, is basically an outside, the market makes a new low, and that's the poke bar, okay, and then it reverses where that close is above the last 2 closes. I call that a 2 bar outside reversal, and if you can look on it as an outside bar that hasn't quite got there, okay, it's a really good pattern. One of those, if that's a 21 bar low, it takes out the lost motion low across there, and we're in the direction of the trend. You can't go far wrong. Next one, Simon. That's the mirror image. Okay, that closes below those 2 closes. That should be a 21 bar high, taking out a lost motion high across there. That'll slam down the page. Next one, and that's an example of it just there. Next one, Simon. Another 2 bar reversal just there. Next one. And that's another one, same thing. And next one now.
Sorry, yeah.
This is potentially the most explosive pattern in markets. I call it a pop gun. If you get a bar, and then an inside bar, and then an outside bar, invariably that breaks. Now, if you look at the DAX chart, the DAX moved, the last time there was a pop gun on a daily chart in the DAX, it moved 1,000 points. 1,000 points. So that's a pattern to look out for, and clearly if that's the poke bar, then you're looking for one hell of a reversal. Yes, Simon? And that's the mirror image, and then we have another inside bar called a narrow. And next one, Simon? It's the mirror image. Keep going. So simple rules, guys. Define the trend. You can put on an 89 period average if you wish, but simply looking at the chart is good. In a downtrend, observe the market rise and take out a major high. Is the poke bar a 21 bar high? If so, sell the low of the poke bar and manage the trade. Remember, on the 4-hour chart, look for 30 ticks for a third. Pull your stop loss up to entry on one of the thirds left. Get your stop loss to minus 30 on the other third. You're now in a risk-free position. You're not going to, if the trade falls apart, you're not going to make any money, but you're not going to lose any money. Okay? Next, the buys are reversed. Trade in the direction of the trend. In a neutral market, you can go both ways. And consider trading against the trend if the market has made 3 drives. Let's have a look at the 3 drives, which is the next pattern. Now, there's the FTSE on Wednesday morning. I traded on a 30-minute chart. For example, there was the trade the previous day. That's like taking sweets from children. Now you can see it. Can you see it? Market comes down and takes out that low. And there's the poke bar. And you put an entry there with the stop there, and away it goes. All right, now there's another entry here that from a Fibonacci pattern, but I can only get the one thing over today. Okay, it normally takes me 3 days to do this. And then we get this 3 drives pattern. That's the first, that's the second, that's the third. And this was the open, and it goes up here. That's a 21 bar high. Takes out that level. It's a 3 drives pattern. Breaks that low, falls down the page. That was 2 trades in a row based on the same system on the FTSE. Just keep going.
We need to wrap up the next
couple
of minutes.
2 minutes, and then we're going to go. That was a 21 bar high. Breaks down through that low, comes down. And believe it or not, I'm short of this market at the moment based on this particular pattern. Because it went up, took that high out, and then turned there. So I'm short of this. And there's the 3 drives. 1, 2, 3. Okay. Next one, Simon. That's, I've talked about that. Next one. As I say, in the stock market, the shares that you buy should have a great fundamentals, and that's the reason that I use VectorVest, okay? I only go long positions in shares where those shares are growing their earnings strongly and aggressively. The next. Any of you that want to try VectorVest, I'm more than happy to give you a 60-day trial for a £5. And if you don't think the £5 is the best use of that £5 you've ever spent, you can have it bloody well back after 60 days. Okay? So it's £5.95. It's a full 60-day trial. Comes with a CD course and telephonic support, and it's £5.95. That's the link. Okay? And Simon will give you the link with the greatest of pleasure. Now, the last thing that I'm going to say, because we've got a young man stomping at the bit here. Tomorrow afternoon at the Hilton at Tower Bridge, I'm doing a 3-hour trading talk. If you felt this was interesting, then you're more than welcome to come along tomorrow afternoon. It's at the Hilton Tower Bridge, 1 o'clock till 4 o'clock, okay? The only thing at risk will be the £5 for the 60-day trial, okay? I've just spent £8.50 on a miserable sandwich upstairs that I wouldn't feed to the dog, okay? Greasy is stuck to the roof of my mouth. So that's me. I hope you enjoyed the talk. I can guarantee that if you make that stuff your own, you'll find that money will fly to you. Okay? It's priceless. Thanks very much.
Thank you, David.
Great. I think we're just going to carry straight along because we're almost on the half an hour. Just give me a second to put the slides up and then we'll be away.
Simon. Hello. Rishi forgot that's the one. You're on page. Hi. Yes.
Guys, if anyone wants to stick around, we're going to start in about 2 minutes. And I'm basically just going to give you some of the best strategies that I've ever learned. So have your pen and pad ready. We're going to learn some pretty incredible stuff. You get two there. Yeah. Oh, that's just one. though. Sorry, man. It's at the car bridge. Motor car bridge station. It's probably not.
Oh, wait a minute. No, it's just because I've been... Right. Okay, should be good to go.
So we're just about to start, I think.
I'll see you tomorrow.
Just so I've got an idea of who's here. How many people are already trading Forex? Anyone already trading Forex? Yeah, about half of you. Trading shares? Not as many. Okay, mainly Forex. Cool. So I think we'll begin. Simon, all set and ready from your side of things?
All ready to go.
Yep. Okay. So hello to the people. There's people watching this on a webinar at home as well. So hello to you guys. So the plan is, well, first of all, just a quick show of hands. Raise your hand if you would like to have a good, reliable way of investing that will consistently grow your wealth. Good. I'm in the right place. Actually, raise your hand again if you'd like that way of investing to take up hardly any of your time. Excellent, because that's exactly what we're going to cover in this session. So, first of all, what I thought I'd do is just go straight into some chart patterns. And I'm going to give you 9 chart patterns that work very well for Forex trading. Whatever time frame you're trading, they're just very powerful patterns. So we'll go straight into these. They also work for share trading, but specifically work great with Forex trades. Reversals first. Let me just explain. There's really 3 main types of chart pattern you can use. One are called reversals. When you see one of these, if the price is going up and you see a reversal chart pattern, it should then change direction and start to come back down. That's the first type of pattern. Another type are called continuations. When you see these, if the price is going up, you see a continuation chart pattern, it should continue going up. They're the 2 main types of chart pattern. There's one other type which we call consolidations. And with these, after a consolidation pattern, you usually get quite a big move in price, but it could go either way. So what you do is you wait for it to break out, and whichever way it goes, that's the way you trade. So let me give you a few good ones on each of these. First of all, let's do reversals. So, first one, you get a big move down. You see this pattern at the bottom here, where the price starts to bounce, but the bounces start to get bigger. We call that a broadening pattern. And after you see that, the price should change direction. It's a reversal pattern. So what's going down should now come up. And you can see that on all different time frames when you're trading. Next one, a rectangle. Similar thing, it goes down, then it kind of does this channel pattern on the bottom. Again, a very good reversal pattern. If you ever see that happen, the price is then likely to head back up. And the last one, price comes down, starts to bounce, the bounces start to get bigger, the oscillations start to get bigger. It means it's getting ready to reverse, usually. Thanks, Natasha. I'll just grab this laser pointer. Now, that's reversal patterns. Let me give you a couple of continuation patterns here. First of all, we've got a small rectangle. We've also got a flag and a pennant. Now, the thing with these patterns is, what you're looking for is a big move in price, and then a small pause, and then usually you'll get a big move of a similar size afterwards. So the flag, pennant, and the rectangle, they're all very similar patterns. The key with this is, when the price goes up and then does the little pause pattern, if you want to know how far it's likely to move afterwards, you measure this distance here, and when the price breaks out of the pattern, it normally moves by a similar distance again. So that would be your target for those types of patterns. They're continuation patterns. Last little group we'll look at, well, a few examples first. There's a flag, price moves up, does the little flag, and then you would buy just there as it takes off. This one comes down, does a little pause, a rectangle. As it breaks down, you then do the down bet just there as it starts to drop. This one moves up, does a little pause, you buy it as it breaks out there. These little continuation patterns work very well, particularly in Forex trades. This last group, consolidation patterns, we've got a symmetrical triangle, ascending triangle, and descending triangle. With all of these, the price starts to bounce, and it slowly gets smaller and smaller. There are 3 different types of pattern, but they're all the same kind of thing, a consolidation pattern. And after any of those patterns, you generally get a fairly big move in one direction or the other. So you wait for it to break out, and then you trade in that direction. A couple of quick examples. This is the US dollar, Japanese yen.
Nice symmetrical triangle there, goes into a point, breaks out, and then we've got a huge move up. Next one, we got the euro pound there, ascending triangle, price goes into a nice triangle there, breaks out. When it breaks out, we trade in that direction, up it goes, huge move there. Last one, we've got a descending triangle here. This is Australian dollar, Japanese yen. Goes into the descending triangle, goes into a point, breaks out. We trade in the direction it breaks out, a nice move up. So whatever you're trading, whatever time frame, look out for these patterns. They're very powerful. Now, how do you get good at investing? First of all, did you know 95% of traders and investors lose money? Did you know that? Yeah, 95% of traders and investors lose money. When I heard that statistic, I got excited. Because I thought to myself, where's that huge amount of money going? Where is that huge amount of money going to? The 5% who know what they're doing. And I thought, if I can just get into that 5%, then that huge amount of money is coming my way. And it's actually a lot easier than you might think to get into that 5% once you know the right strategies. Now, what's the average investor's approach to investing? Average investor's approach is read a few books on trading, maybe. Go online, try and learn a few strategies, maybe. Perhaps attend a course. And then what does the average investor do? They take out a big chunk of their life savings, put it in the Forex markets, put it in the stock markets, and what normally happens? Normally lose a lot of money pretty fast. Yeah. When I first started out, I tried the average investor's approach to investing. I can tell you the statistics are correct. I lost a lot of money very fast using that approach. So I thought I better get good at this stuff. And I decided I wanted to become outstanding at investing. Initially, I read almost 300 books on trading and investing. Forex, stock market, options, commodities, indexes, technical analysis, fundamental analysis. I then attended over 30 investment training courses all around the world, in the UK, in America, in Russia. I then tracked down some of the greatest living investors in the world, and I persuaded them to teach me one-to-one, just me and them. And I got to learn literally from the best traders in the world, personally, one-to-one. I learned from the guy who won the World Trading Championships. With $10,000 within 10 months, he turned into 1.1 million, real money. Spent the afternoon with him while he taught me how he did that. I learned from a guy who made £1 million profit from trading in 30 seconds. Louis Borsellino. Spent the afternoon with him. Got him to teach me how he did that. I wanted to learn about Bollinger Bands. Who did I learn from? John Bollinger. Spent the afternoon on the sofa with him. Just the two of us with our laptops while he taught me how he did that. After doing all of that, I came back to the UK, applied everything I'd learned. Within a few years, I was a multi-millionaire. In this talk, in the next kind of 25 minutes, I'm going to give you some of the best stuff that I learned. Some pretty incredible strategies. So if you've got a pad and paper, you're going to want to write some of this down. So this is what we're going to cover. Actually, first of all, if you're interested, here's a few of the people I learned from. That's me with Rob Hoffman. He won the World Trading Championships 3 times. This is Louis Borsellino. He's the guy who made over £1 million profit in 30 seconds. I spent a couple of hours with him, just the two of us. This is me with John Bollinger. I spent the afternoon with John, sitting on the sofa while he taught me his strategies. This is Larry Williams. He's the guy who went from 10,000 to 1.1 million in 12 months. Spent the afternoon with him while he taught me his strategies. I also wanted to learn from anyone who'd become really wealthy, whether it's stock market or anywhere. And I got to spend quite a bit of time with some very, very wealthy people from all over the world. I got to spend some time one-to-one with Richard Branson while he was teaching me his strategies. Let's get into the content. What are we going to do? So this is what we're going to cover in this session. I'm going to give you the smart way to invest, a system I came up with based on learning from some of the world's top traders. I'll give you the power of sector investing, extremely powerful strategy. I'll show you exactly how to do that. I'll give you a simple high profit, low risk strategy. I'll show you how to protect your capital. I'll show you how to make money even if you get more than half your trades wrong. Now, if you have any questions, I say if you can save them until the end, that way we can check, we get time to cover everything. Now, in this next 25 minutes, I will give you some of the best investment knowledge in the world. I'm going to give you proven strategies that work, so you just need to jot this stuff down. You will get a lot of value in this session. What I would say is, to check I remember to mention this, if you want to know more after this talk, we run a 2-day training course. It's on Forex and stock market investing. It's actually the most popular investment training course in the country. Over 10,000 people have attended our investment training course. It's actually been the most popular for over 12 years now, and we won Best Investment Training Course in the country for 3 years in a row. Anyone who's interested, the investment for a ticket is £2,000, it's £1,997, and we hold the course about once a month. There's one actually next weekend, and then we have 2 at the start of May, 1 in June, 1 in July. Now, I normally don't teach any of these courses. I normally don't teach these free events. I normally don't teach the paid courses. I've got course instructors who do this for me. But what I'm doing is I'm currently updating all our course material. So I am going to teach these next 5 courses in person. Then I'll be handing back over to my course instructors. So let's begin. Sectors first of all. This is going to take me probably about 5 minutes to explain. It is highly profitable, very powerful, and virtually no one knows about this. I'll give you the exact strategy of how to trade it. If you're a complete beginner, that's fine, you'll still understand it. Stick with me, it's definitely going to be worth you knowing this. And so it's going to take me about 5 minutes to explain. Let's go. So this very first bit of the talk is going to be 5 minutes on shares, then we're going to go back to Forex again. What influences your share price? Well, certainly the whole economy does. What happens to the whole economy? What happens to the stock market will affect your share price. What happens to the sector will affect your share price. Anybody, what is a sector? Sector is... Yeah, it's kind of a sector is just like a big group of companies. So, for example, you could have the technology sector, the financial sector, the transportation sector. And then within the sector, we have the smaller bit, which is the industry. So within the technology sector, we'd have the computer software industry, computer hardware industry, electronics industry, the smaller bits. And then we have the company itself. Now, the question is, how much influence do you think the market sector and industry has over what happens to your company share price? A lot, yeah. About 80%. About 80% of what happens to your share price is dependent on these things here. So how can we use this to make a lot of money from investing? This is how. Well, first of all, let's just quickly talk about the economic cycle. 2 main stages in the economy, what are they? Boom and bust, yeah, boom and bust. In investing, we sometimes call it expansion, contraction. Same thing, just a fancy word. It's useful to break this down into 5 stages. We break the boom stage into 3 bits. Early expansion, middle expansion, late expansion. We break the bust bit into 2 bits. Early contraction, late contraction. Now, why is that useful? This is why. Certain types of share tend to do very well at certain stages in the economy. For example, technology companies tend to do very well just here at early expansion. Healthcare companies tend to do very well just here at early contraction. Now, so if we know what stage of the economy we're coming into, we can buy shares in the right types of company, the ones that are supposed to do well. Let's just check everyone's following along so far. So if we were coming into early expansion, what types of share do we want to buy? Technology, yeah, because they're supposed to do well at this stage. If we were just coming into early contraction, what types of share do we want to buy? Healthcare, yeah, because they generally do very well at that stage. Now, in 1 minute, I'm going to give you the strategy. First of all, let me just give you all the details. At each of these stages, which types of companies should I invest in? Well, at early expansion, the types of shares that tend to do very well are capital goods. That's things like engineering, manufacturing, machinery, technology, and transportation. At middle expansion, capital goods still do very well. At late expansion, energy shares, basic materials, and consumer staples do very well. Anybody wants a consumer staple? An example? Consumer staple? Yeah, somebody said is food is an example. Things that we use all the time. So like food, alcohol, tobacco, cosmetics, healthcare, they're all consumer staple. At early contraction, consumer staples still do well in utilities. Anyone? Utilities? An example? Gas, electric, yeah, services in the home. And late contraction, financials do very well in consumer cyclical. So, what's the all-important question? Oh, afterwards. What's the all-important question? Where are we now? Yeah, because if we know where we are, we can get into the right types of share. There's actually a better question, which is, How can we find out where we are so that you can do this all the time? There are really three main steps to doing this. I'm going to give you the first one now, which will give you a quick, rough way to do this so you can get started straight away. So this is how you do it if you want to find out where we are in the cycle. One way is go to the Financial Times website, the FT website, or buy a copy of the Financial Times newspaper, and there's a section in there called Leaders and Laggards. And it lists all the UK sectors. At the top of the list are the sectors that have gone up the most. At the bottom of the list, sectors that have gone down the most. And you look at about the top 10, 12 sectors, and you ask yourself which sectors have done the best. So in this example, we have health, personal care, pharmaceuticals, tobacco, food, and drug retail. What are all of those? They're all consumer staple. We then had water, gas, utilities. What are all of those? They're all utilities. So consumer staple utilities was doing very well. Whereabouts were we? Consumer staple utilities, early contraction. That's exactly where we were. It took about 5 seconds looking at the FT website to work that out. Let me give you another example, another way to do this. Lots of the free financial websites have a tool called a sector heat map. A free tool called a sector heat map. One website that has it is marketwatch.com. This is a sector heat map. Each of the squares with the thick grey outline is a sector. So for example, we've got the energy sector, the financial sector, healthcare sector, consumer cyclical, technology. Each of the smaller squares is a company. Each of these smaller squares. Now the brighter red the square is, the more the share price has gone down for that company. The brighter green the square is, the more the share price has gone up. Now, we use this in quite a sophisticated way. We say to ourselves, which of the sectors is greenest? That's it. In this example, nearly every square in consumer cyclical was green, and half of technology is taken off in a really big way. Consumer cyclical, half of technology. Consumer cyclical, half of technology. Whereabouts were we? Swapping over between these two stages, yeah? So what types of shares would you want to buy? Well, capital goods, technology, transportation, because they're supposed to do well. Now, I'm going to show you a real example of how profitable this can be. So once we find out which of the stages we're coming into, we're going to buy the right types of share. As an example, we did the research a couple of years ago. We found out that we were just coming into the early contraction stage of the economy. Very obvious. We did all 3 steps. You get very good at the timing if you do all 3 steps. Found out we're just coming into early contraction. We found out which sectors should do well at that stage. Consumer staple utilities. We found out which industries are within those sectors. So consumer staple is made up of hospital management companies, beverage, tobacco, cosmetics, healthcare. We did the same for utilities. What are we going to do next? We're just coming into this sector. These are the types of company that are supposed to do well. What do we do next? We buy shares in these types of company because they're supposed to do well. I'll show you a real example of what happened next. Rather than show you individual companies, I'm going to show you what happened to these whole industries. So you can see on average what happened to every company within that industry. So first of all, hospital management company is supposed to do well. Red line is the stock market plummeting. Blue line is hospital management companies. Went up over 100% profit in a year, on average. So that's how much you made if you picked a random company in the right industry. It's supposed to do that, no surprises. Let's look at another one. Electric companies supposed to do well. Market, the red line plummets. Electric companies went up over 70% profit in a year, on average. Again, they were supposed to do that. Let's look at another one. Beverages supposed to do well. Market plummets. Beverages went up over 50% profit in a year, on average. They were supposed to do that. Now, 50% profit in a year. We wouldn't bother with crummy returns like that, would we? Maybe. Yeah, let's look at another one. I'll go through each of these. Natural gas is supposed to do well. Market goes down, natural gas went up over 60% profit in a year. Tobacco is supposed to do well, went up 140% profit in a year. On average, this is how much you made if you closed your eyes and picked a random company in the right industry. It was supposed to do that. Now, Do we just want to close our eyes and make 140% profit in a year? Well, yes, but what can we do that's even better, yeah? This is how much you made if you picked a random company in the right industry. What can we do that's even better? Pick a good company in a good industry. Good company, good industry, 475% profit in a year, 500% profit in a year. When I learned this stuff, it totally turned my investing around. Most people have absolutely no idea about this. If you're a complete beginner, you now have a massive advantage over most people. If you're already investing, you've got to be using this. It's so powerful. Now, I put there, £2,000 would have become £12,000 in a year. £10,000 profit for 45 minutes work. Now, in reality, would the returns be quite that big? Well, probably not quite. You might miss the start of the stage, you might miss the end of the stage. If you only made 300% return in a year, would that be okay? I hope so, yeah. Now, real trades, real money. Do people make these kind of returns from doing this sector investing? Yeah, absolutely. A few of our course graduates, 500% profit in a year. I attended the course over a year ago. I started with £2,000. I now have well over £10,000 of profit using exactly what you just learned. Another of our course graduates, £3,000 to £47,000 in 9 weeks. Between a period of 8 to 9 weeks, I made my £3,000 initial investment grow to £47,000. Again, using part of what you're just learning here. Another course graduate, 242% profit in 8 months. This guy sent me in all his spreadsheets. He was using my exact strategies. Now, in 3 minutes, I'm going to teach you 2 more strategies, 2 very powerful strategies you can use for Forex trading and share trading. I'll give you those 2 strategies in 3 minutes. First of all, anybody feeling lucky? Couple of people, okay. Before the end of this talk, I'm going to give one of you the chance to get our Investment Success Home Study course for free. It's normally £1,000. Many people have bought this from us for £1,000, and they are very glad they did. It's an incredible home study course. I'm going to give one of you the chance to get this for free before the end of this talk, in the next kind of 10 minutes. It's basically 6 DVDs of me teaching my best strategies that I learned from trading with the world's top traders. Plus you get the Investment Success Home Study book, you get the summary sheets, the best indicators, the best chart patterns, pretty incredible program. I should say, if you're a complete beginner or you're just getting started in this, on the first DVD you'll master the basics. And we talk step by step exactly how to get the best results in trading and investing if you know nothing about investing at the moment. Second DVD, you cover the amazing power of the big picture. We touched on it today. There's even more powerful strategies on that DVD. Third one, 4 simple rules for finding the best trades. I give you 4 simple rules for finding the very best Forex trades. And also for finding the best share trades, and commodity trades, and index trades. And on the 4th DVD, I show you how you get your computer to do virtually all the work for you. So it takes literally 1 hour a week to do this stuff. And it can be in the evenings, it can be the weekends. So if you have a full-time job, it's very easy to do these strategies. And the 5th DVD, you get the 6-step formula from optimum results. It's the best strategy I've ever come across after learning from the world trading champions. And I give you that strategy. And the last DVD, we master the technical analysis in a very simple way where everyone can understand. As at £1,000, it's well worth it, but I'll give one of you the chance to get this for free in the next 10 minutes. First of all, let me give you a couple more strategies. This first one here, channeling strategy. I'm going to give you the basics of it, then I'm going to give you an advanced bit that makes it even more powerful. Quite often, prices will bounce up and down in a very regular, uniform way like this. When they do that, we call it channeling. If you saw a price doing this, when it comes down to this invisible price level here, which we call support, it tends to bounce and go up. When it gets to this invisible price level here that we call resistance, it tends to bounce and come down. If you saw a price that was doing that, when would you want to buy it? You'd want to buy it when it's near to support, yeah? When would you want to sell it? When it's near to resistance, yeah? Right now in the UK, there are many companies whose shares are doing this channeling pattern right now. Right now in America, there are many companies whose shares are doing this channeling pattern. Forex trades. There are always channels on some time frame for Forex trades. Now, let me show you a few examples. This is the Australian dollar, US dollar. This is about a year and a half ago. And what happened? It went up, down, up, down, up, down, up, down. Fantastic trade, highly profitable. Anyone trading that channel? Oh, no one. Wow, one person. Incredibly profitable. It was a great trade. Not anyone heard of this little company? It's Microsoft, yeah? Microsoft doing a channel. So what do? You buy here, sell, buy, sell, buy, sell. On the 2-day training, I show you how to make money as it comes down as well. Just as easy. If you traded that channel, 150% profit in a year. Pretty good. UK example. This one, so what do? You buy here, make money. Buy here, make money. Buy here, make money. Buy here, make money. And trade it as it comes down. That one did 70% profit in 5 months. Another UK example, 60% profit in 6 months. Another UK example, 140% profit in 7 months trading that channel. 2,000 would have become almost 5,000 trading that channel. Now, 140% profit in 7 months. Pretty good. But sometimes I trade channels that do even better than that. Here's a trade that I did a while ago. Each of these bounces was about 50% profit. This one did 180% profit in a month trading that channel. 2,000 would have become over 5,000 in a month trading that one. Now, I hope you're thinking a couple of things. And one of them is, well, this channeling stuff looks very easy, it looks highly profitable, and I want to do it. I hope you are thinking that because it is. But I also hope you're thinking something else. And that is, well, I bet as soon as I buy it, what happens? It stops channeling, yeah, and goes down. Could that happen? Well, yeah, of course it could happen. So you need a way to protect yourself from that happening. Let me give you a very quick way to do this. Use an indicator called ROC. Use an indicator called ROC, and the setting is 14-day setting. You'll find it on any of the free websites. Now, what you do is, if the indicator makes a lower bottom than the one before, you don't do the trade. That's the rule. That will protect you in about 80-90% of the cases. This then becomes a very profitable, very effective strategy. Now, again, real trades, real money, do people make these kind of returns? Yeah, absolutely. Here's another of our course graduates. £6,000 profit with channeling. From an initial stake of £1,000, I generated a return of £6,000 over 2 months. Technique I was using was channeling along with your recommended indicator. £1,000 made 6,000 profit in 2 months. Yeah, pretty good. If you started with £1,000 today and you made £6,000 profit in 2 months, would you be fairly happy with that? I hope so. You're going to learn exactly how to do that on the course. And it's very easy to find those channels once you know the strategy. Now, last little bit and we'll kind of wrap up. So 2 last things I'm going to give you, and then we'll kind of wrap up. And these are probably the most important things you'll ever learn in investing. First one, let your profits run, cut your losses short. Is probably the #1 most important thing. What do most investors do? Most investors do the exact opposite. Yeah. Most investors cut their profits short and they let their losses run. I'll give you a quick way to do this the right way around. Price goes up, price comes down, bounces once, bounces twice. If the price bounces at about the same level, we call that a double bottom chart pattern. Very simple, very basic chart pattern. And it means that just here, it's now more likely to go up than go down. So that's a reasonable place to buy after this double bottom bounce there. Now what you want to do is, you want to place a sell stop below this price bottom. Place a sell stop there, and that means if the price ever drops to that level, it will be sold automatically. Now, why would you do that? Why would you do that? Limit your losses, protect your capital, yeah? Now, as soon as the price goes up, when we get another price bottom here, we cancel that sell stop and we move the sell stop up to there. I've now guaranteed I made a profit because I've locked in that profit. Price goes up, another price bottom, what do? Cancel this sell stop, move it up to here. Price goes up a bit further, another price bottom, I cancel that sell stop, I move it up to here. What's the biggest loss I could make on this trade? Well, I can buy it, it could go down to my sell stop, it's automatically sold, so I have a limited loss. What's the biggest profit I can make on this trade?
Anyone? Biggest profit? Unlimited. It's actually unlimited. I'm just going to keep moving my stop up. Yeah? Unlimited profit, limited loss. You've got to be trading that way. Whatever you're trading, whatever time frame you're trading. Now, last little bit, and then we're kind of done. Reward to risk ratio. Price goes up, comes down, 1, 2, same example, we buy just there, sell stop goes just there. We've said that we've got a limited risk, which is this, it drops, is sold, we've got that as our limited risk. Now, whatever you're trading, whether you're trading Forex, shares, commodities, whatever time frame, it's a good idea to have a target of where you think the price is going to go. Now, in this very simple example here, if the price started to go up, it's quite likely it's going to stop at this peak here, because this big price peak will act as a resistance level. So that would be a reasonable target if this thing starts to go up. What you've got to make sure is the distance from where you buy to your target, which is the potential reward, you've got to make sure that that is at least twice as big as the potential risk on every trade you do. Now, if you are only going to get into trades where the reward was twice as big as the risk, and you only got half of your trades right, would you still be making money? Yeah, absolutely, even if you only get half the trades right. Because when you win, your win is twice as big as when you lose. I only get into trades where the reward to risk ratio is at least 2 to 1, usually 3 to 1. Sometimes I get into a trade where the reward to risk ratio is 5 to 1 or even 10 to 1. If you only got into trades where the reward to risk ratio was 10 to 1, how many of you got to get right to be making money? 1. Pretty good. Occasionally I find a trade where the reward to risk ratio is 50 to 1 or 100 to 1 or 400 to 1. I actually found a trade a while back where the reward to risk ratio was 1,200 to 1. How many of you got to get right out of 1,200 to be doing okay? 1. Yeah. You'll be pleased to hear. Our course graduates do quite a bit better than that. 70 winners out of 72. I attended your course a year ago. I've been successful in 70 out of 72 trades. I taught him a very simple, very effective strategy that I'm going to teach you on the course as well. It's an excellent strategy. Another course graduate, £500 profit per week. After the seminar, on average, I make £400 to £500 profit per week. Best thing of all, I'm only using £2,000. Another course graduate, £250 started with, turned it into £1,500 in 3 months. Another course graduate, £30,000 profit within 4 months. Another course graduate, £2,000 to £11,000. Another course graduate, £24,000 profit in 1 week. Now, we have literally thousands of success stories from people who've done our training course. How have we managed to get so many success stories? Because the strategies work that you're going to learn. Now, in 1 minute, I'll share with you probably the best bit of advice I've ever been given about becoming truly wealthy. I'll give you that in 1 minute. First of all, I mentioned the course earlier. Give you a couple of very quick details and then we'll wrap up. 2-day training course. It's on Forex and share trading. It is the most popular, best investment training course in the country. The investment for a ticket is £2,000. But because we're at an event like this and we're seeing so many people, I decided that we're going to give you a pretty amazing offer. And the offer I'm going to make is pretty incredible. You'll definitely want to hear this. First of all, let me just explain the dates. So we've got a course next weekend, 21st, 22nd. Then we've got 2 at the start of May, 1 in June, 1 in July. They're all in London. We have an office in London that we own in London Bridge. I normally don't teach the courses. I've got course instructors who teach them. But as I'm updating the course material, I am actually going to be teaching these next 5 courses in person. So, and once you book a place, you can change the date if you need to. Already talked about the investment for a ticket, £2,000. What I'm going to do is, as a bit of a marketing experiment, because we're seeing so many people, also, I need your permission. I'm going to film one of these events. If you agree that I can, that you'll appear, the back of your head will appear in the film, you can be part of this marketing offer. If you want to book your place today, I should say thousands of people have already paid £2,000 to attend the exact course I'm offering you now. Thousands of people have already paid £2,000 to attend the course I'm going to offer you now. If you want to attend that exact same course and you book your place right now, I will give you a £2,000 seminar ticket for just £97. And that is exactly the same course that the people paid £2,000 for. Everything you need to know, all the strategies. Now, at this stage, usually someone will say to me, wow, that is actually pretty incredible. I'm definitely coming on that course. That's pretty amazing. Usually the next part of the question is, I'd like to bring my husband, my wife, my brother, my sister, my cousin. How much for the second ticket? If you want to bring someone else, the second ticket is £2,000. That is the price. That's the normal price for the ticket. You're here, they're not here. So if you want to bring someone else, you can, but their ticket will be £2,000. But then I got thinking to myself, well, if I'm doing this offer, it's already pretty amazing. Let's take it all the way. If you book your place right now, I will give you the second ticket, the second £2,000 ticket for free. £48 each. Now, I promised that I'd give one of you the chance to get the £1,000 home study course for free before the end of this talk. I've changed my mind. I'm not going to do that anymore. I'm going to give 12 of you the chance to get the home study course for free. The first 12 people who book a place today, I'm going to give you the £1,000 home study course for free as well when you attend the course. If you're listening to the webinar at home, I'm going to do the offer for you as well, and I'll give you a link in a second where you can book this. So, the first 12 people who book a place today, I'll give you the £1,000 home study course for free as well when you attend the course. That is the normal price, £4,994. This is what people have actually paid for what I'm offering you now. Exactly the same thing. For you, it would just be £97. People who are watching the webinar at home, the first 12 people, if you go to that website, I'll also make it available to you. Now, plus, oh, by the way, if anyone wants to grab a place straight away, put your hand up and we'll hand out a form now. I've got 1, 2, 3, 4, 5, 6. So you can hand them out. 7, 8. You also get a guarantee. Anyone else put your hand up? We're going to do this for the first 12 people only. So another one there, another one there. That's 10, 2 more. You also get a 100% money back guarantee. I guarantee that at the end of day one, if you don't think that this was the best course you have ever been on, worth at least 20 times what you've paid for it, if you decide you don't want to come back for day 2 for any reason whatsoever, I will give you 100% of your course fee back, no questions asked. And you get to keep the course material. You can't get much fairer than that. So if you were even slightly skeptical, you now have 0 risk. All the risk is on me. Because I know how good this course is. I know after doing day 1, you will definitely want to come back for day 2. So, as promised, the first, well, I promise you this bit of advice. The person who gave it to me was very wealthy and also very, very successful. And he said, if you want to be truly wealthy in life, be grateful for what you already have. Now, that really is true. I'm grateful for having the chance to share this with you all. I really do wish you great wealth and success with this. I would love to see you on one of these courses soon. First 12 people only. I'll give you a £1,000 home study course for free as well. If you'd like to book a place, you can see our team who are now in that corner over there. First 12 people to fill in the form, you're going to get the place. 10 of you have already got the form, 2 places left. Thank you for listening and hope to see you soon. Thank you. If you can just take a note of a number as they come in. So first 12 people who fill in the form, we'll do this for free. And if you haven't got a form, if you just put your hand up and we'll hand you a form as well. Well, I should say, just in case anyone's still listening on the webinar at home, same offer applies for you, first 12 people. If you just go to that website that's on the screen there, wealth-training-com, company.com/offer. First 12 people who book online, I'll also make that same offer available to you.
fill in the form and hand it over there. You don't need to fill that in. Your name, just your address. No, when you're attending course, you don't study.
Hello to everybody still on the eShow. That concludes our presentations for today. So I do thank you for joining us, and extend my apologies to you for the slightly inconsistent audio feed that we've had, and the inability to be able to respond to your questions just as normally quickly as we do on the other webinars. We will try and make that improved for the next time we do this live broadcast. In the meantime, I hope you managed to certainly get some value from that. Just to confirm, we have recorded the presentations today, so we'll get that link out to you in a few days' time, if not sooner. And we're glad you were able to join us. Our next webinar event is the Round the Clock Investor, and that's taking place on the 5th of March. And again, that's the big 12-hour event that rather than full-on sort of trading content, we're going to be looking at some portfolio management, some portfolio building, wealth management topics on that course. And again, at the end of March, 26th of March, the Round the Clock Trader will be back again, and we've got some exciting new speakers lining up for that. So, as always, I'll keep you up to date with all these developments, and wish you luck with your trading, and thank you again for attending, and wish you a pleasant weekend. Thank you very much. Bye-bye.